There he is. Oh, we don't hear him, though. We can't hear him.
I'm going to start over. Charlie.
You should tell him that we can't hear him.
Charlie, can you hear me?
We can't hear you, Charlie.
He's waiting.
It's a long way from Colorado.
Florida. Yes, they know.
I can hear you, so the problem is on their end now.
Oh, okay. Thanks, Debbie.
Okay, we can hear you now, Charlie. We can hear you now.
So I'm coming through now?
Yes, you're coming through, so please start at the beginning.
All right, sorry about that. The wizardry of technology. Good morning, everyone, and let me just welcome everybody to this meeting of the Shadow Open Market Committee. We're delighted to have you with us. I apologize for not being there in person, but that's the way the cookie crumbles sometimes. But I am here, and I'm delighted to be at this meeting. I think it's going to be a fascinating meeting. We have not only shadow members delivering papers and discussion, but we're also delighted to have with us today Michele Bowman, Governor of the Federal Reserve Board, and she's going to join us at lunchtime. And we're both privileged and honored that she has taken the time to be with us today. And I'm sure her comments will be fascinating to everyone. Our panels today kind of focus on two sorts of themes. The first, of course, with Debbie Lucas and Charlie Calomiris, is going to be about financial issues, in particular financial regulation, and a general approach to how banks and the government should interact with our financial institutions. I think it's going to be a fascinating discussion. I suspect it will be very thought-provoking as well, and I hope it will generate lots of discussion within the group. And so I'm very much looking forward to that. Our second panel is going to be about not about regulation in financial institutions, but be more about monetary policy and the Federal Reserve itself. We'll have several discussions about governance, about approaches to governance at the Fed, and also about strategies, or new strategies, if you will, about how the Fed should conduct monetary policy. As most of you know, the Fed adopted its long-run goals, objectives, and monetary policy strategy first in 2012. It revised that review or that statement in 2020, and that's generated lots of controversy. Some of that you've heard from myself and Mickey and other panel members on the SOMC over the last 2 or 3 years. The Fed has announced that it's going to undertake a new review, which personally I think is long overdue. But so that will be part of our discussion, as will be some issues in terms of governance and processes within the Fed to improve both communications and their strategic outlook. I myself have written on that several times, and I'm looking forward to the conversations by Andy Levin and Jeff Lacker in that regard. And of course, Peter Ireland and Athanasios Orphanides will talk more about current monetary policy strategy. So again, let me just close by saying welcome to everybody. We're delighted to have you here. I think we're going to have a fascinating meeting, and I hope you enjoy it. And so I turn it back to Greg Hess, who is going to be the moderator for our initial meeting. So thank you very much.
And thank you, Charlie. As Charlie mentioned, I'll be the moderator for the Regulatory and Capital Framework panel. And I just wanted to give a quick introduction to just give some scope to it. There is something inherently fragile and risky in the conceptual frameworks of a bank where reserves are held on a fractional basis, that there's a fundamental maturity mismatch of assets and liabilities, and there's a presumption that a certain kind and amount of bank liabilities, i.e. deposits, are deemed safe and on demand. And yet banks as we know them are crucial to family and business health, particularly small business health in the United States. Because of the importance and the inherent fragility of banks, both regulation and supervision are critical, and they are not the same thing. The former is about finding the right rules to keep some liabilities, for example, deposits, safe, while balancing off the risks of their assets and loans and other liabilities that they may have. The latter, supervision, is about oversight, political incentives and calculus, decision-making tenacity, and the occasional presence or absence of courage, which is the ability to do the right thing at the right time. Today's remarks by my colleagues Charlie Calomiris and Deborah Lucas are broadly associated with the Basel III Endgame, that is the final step in the post-2007-2009 BIS guidelines for requiring banks to raise capital on a risk-weighted basis to offset operational credit and market-based risk. And they will also touch upon the bank crises of 2023, that is Silicon Valley Bank and First Republic. Both presentations focus on whether our current and proposed regulatory and supervisory systems move us forward or backward in how economic policy can best be brought to bear on this tender balance between the critical economic importance of banks and their inherent risk and fragility. So I'd like to now open it up for Charlie for his presentation.
Thanks very much, Greg, and thanks to all of you for being here today. I think I should begin by explaining the title for my paper, which is, What is a Bank, What is a Government? Which is kind of a strange title for a paper about this archaic topic of what little things should we be doing in regulation and supervision. And so here's my explanation. At my age, I find myself reflecting on my 40 years of miserable failure in this area. And it seemed to me that as I reflected on my 40 years of miserable failure, and by the way, I mean, I think it's been a really deep failure in the sense that I've been, I would say, on these topic areas, a leading member of every major academic organization that has tried to deal with it. Let me give you my list. Here at the Shadow Open Market Committee, but also the Shadow Financial Regulatory Committee for more than 2 decades, the Financial Economists Roundtable, the European Systemic Risk Board. So when and I was chief economist at the OCC for a year, trying to implement some of this. So when I say I've had a deep failure, I really know what I'm talking about. And so I feel like when we start talking about this problem, and especially in light of the 2023 crisis, which was so remarkable, not just as a shock, but for the fact that it was maybe you could say the 3rd or 4th or 5th time we should have figured out about these kinds of shocks that we didn't. So when you live through that 40-year period of miserable failure that I've lived through, you start asking yourself whether it's even worth it to talk about the technical side of this question. Because the deep side of the question, which is what my title refers to, is trying to understand what it is about the entities of banks regulated by entities called governments that might be explaining this miserable failure. And of course, this is a topic I like to write about, the political economy of regulation. So let me go now through some of my prepared remarks. So the parts of the academic world that study banks and governments have come to understand that the frictions of the world, which I'll talk about in some detail, the frictions of the world that create government regulation and supervision and that create banks themselves are crucial to understanding how banks operate and government institutions that regulate them and supervise them operate. That is, the really interesting academic stuff to talk about here is really not about great theories of how to make things perfect, but about why things aren't perfect. Those are the frictions. Banks and governments are both intermediaries, but they're not neutral, passive implementers of efficient thinking. They are institutional embodiments of political power. That is, they embody the political decisions that express the will of winning political coalitions who've won battles so that they can be in charge of these decisions. Of course, as intermediaries, banks do what we teach in economics courses. They help to overcome what we call frictions, market frictions relating to physical costs and information costs. And because they compete in a market, that spurs them to behave in a manner that achieves, as best they can, the objectives of their clients to build payments platforms, originate loans, create portfolios for themselves and others. But as government chartered entities, banks' behavior also reflect the rules that governments create for them, which activities they're allowed to do, who they're permitted to serve, what unprofitable actions they're forced to undertake, how their losses and how their profits are going to be allocated. For example, their losses are allocated today very differently from what they were 100 years ago because governments protect banks in so many different ways, especially deposit insurance, but not only. The incentives of bankers, of course, are shaped not just by being market participants with consumer demands, but by all those rules, and especially those loss-sharing rules that have some very big incentives for banks' willingness to undertake risk. Academic work on bank contracting, of course, examines those frictions of the marketplace quite a bit to explain the peculiar contracting structures of banks, why they rely on depository finance, why their loans use warranties, collateral, and covenants of various kinds, blah, blah, blah. Quite interesting. And of course, also help us to understand why the generosity of protection of banks has tended to spur them to take enormous risks. And this isn't just a US problem. When academics study governments, they also focus on the frictions. The whole area called political economy considers how government decisions regarding bank chartering, regulation, supervision, not efficiency per se, but those are guided by political coalitions that are able to win the battle, to decide what those rules should be. And so, for example, to show you why politics matters, let's take the example of federal deposit insurance. Federal deposit insurance was not created in the US in 1933 because the government or its citizens thought it was a good idea from the standpoint of some economic efficiency. In fact, it was opposed by the American Bankers Association, by the Federal Reserve, by the US Treasury, by Senator Carter Glass, and by President Franklin Roosevelt. It was created, nevertheless, because small unit banks in places like Alabama and the government representatives that favored those banks, such as Henry Steele, representative from Alabama, insisted on creating federal deposit insurance as the price for supporting other legislative actions that FDR and Carter Glass favored. If you doubt that, consider what candidate Roosevelt wrote in a letter to the New York Sun during the election of 1932. Federal deposit insurance, he said, quote, would lead to laxity in bank management and carelessness on the part of both banker and depositor. How interesting that he said that. I believe, he went on, that it would be impossible. It would be an impossible drain on the federal treasury. How did Roosevelt come up with those opinions? Because 8 states had enacted deposit insurance in the early 20th century, and all of them had fallen apart and wrecked the banking systems of their respective states in the years immediately prior to the 1932 election. And nonetheless, deposit insurance is probably, in your mind, considered one of the great legacies of the Roosevelt administration. Now, because the literature on bank regulation and supervision today understands how real-world banks and governments behave in predictably suboptimal ways, it's capable of explaining why banks are able, despite market competition, to undertake unproductive and excessively risky strategies, and why government policies, especially prudential regulations related to bank failure risk, don't prevent banking crises or bank failures. From that perspective, the 2023 banking crisis is, of course, no surprise. Rather, it's part of a political equilibrium that creates and regulates and supervises banks. Those of us that propose new prudential policies that would reduce the risks of bank crises understand that the main obstacle to reducing bank excessive risk is not the inherent weakness of banks based on their structure, but rather the political resistance to actually doing things that would reduce bank risk, which reflects the preferences of the political coalition that's effectively in charge of bank regulation and supervision. I mean, this may sound like a Marxist diatribe, but I think it's just called history. Where the academic literature has been less developed, however, and this is going to be the thrust of some of my comments today, is modeling and empirically investigating bureaucratic behavior, including supervisory failures, which the 2023 banking crisis shows were at least as important as regulatory failures for producing the crisis. That is, little of the literature on political economy has focused on the behavior of the administrative state, and in particular, on the behavior of bank supervision. Bank supervision, of course, is distinct from bank regulation. Regulation is about enacting the rules banks face, such as minimum capital ratio requirements or minimum or liquidity requirements. Supervision is about enforcing those rules, but also about supplementing the rules with additional bank-specific, customized, ad hoc prudential interventions based on information supervisors observe as part of their regular examinations of banks. Supervision is intended to complement regulation, both by credibly enforcing regulatory rules and by strengthening prudential behavior through prompt interventions as necessary. These are not just incidental powers, these are core and central to the mission of the supervisory agencies. That is, the whole point of having supervision is recognizing that regulation isn't always going to be, in some sense, inherently flawed. That's going to have some weaknesses. So supervision is there so that when a weakness is revealed in a regulatory rule, you use your discretionary authority to create the prudential outcome that the regulatory rule couldn't by itself create. That isn't just, so when supervision fails after regulation fails, that's a double failure, because the whole point of supervision was to not fail when regulation fails. It's supposed to complement regulation as being an independent source of prudential oversight. And yet, as the 2023 crisis showed, and as even the managers of the supervisory agencies themselves admitted, there's a nice summary by a paper in Reuters by Gillison. There was a paper that had lots of interesting admissions by Mr. Barr in 2023, and there was a candid and thoughtful discussion by Michele Bowman in 2023 too. Both, all of these discussions, I think, are really great in that they talk very candidly, but especially Governor Bowman's, about what the problems were. And of course, there's a lot of academic writing about it too. The regulatory failures had to do with flawed accounting rules for measuring prudential standards, allowing banks to pretend that their assets were worth more than everyone knew they were worth for months. The supervisory failures had to do with not responding to those shortcomings once it became clear that they were creating potential risks and problems. I want to emphasize, it's two shortcomings: a regulatory failure having to do with a bad rule, and then, in light of the bad rule being revealed, not using your supervisory power to do what you're supposed to do, which is fix the problem that the regulatory rule didn't fix. So what are the key problems that made supervision fail? So now let's do a little bit of analysis of how to, and I say this from someone who had a brief experience for 1 year as chief economist at the OCC, which is specializing in examination and supervision of national banks. I would say the key problems with supervision are two. First, it's the combination of unlimited discretion with asymmetric incentives to act. That's the first problem. By unlimited discretion, I mean the supervisors get to create measures, multiple, not a single boiled down measure, but many, many measures of bank health. They then examine, check boxes. Oh, the bank's good on this one, not good on that one. We have 100 different measures, which means we have no measure. We have a lot of, and that's wonderful. I want that job, right? Because then if you tell me that there was a problem, I say, well, but measure number 36 was great. Okay, so unlimited discretion means I don't have to publicize my opinions. In fact, I say that it would be bad if I were forced to. And I have many, many different ones, and it's all about, there's no rule, there's no bottom line, it's just my judgment, and my judgment's based on private information. Wouldn't you love to have that job? No oversight is possible, no accountability is possible. And then with that, of course, is asymmetric incentives. There's always a good reason to delay, especially if you're getting phone calls from politicians who the banks have called and don't think that's not a part of our process. I can tell you it is core to our process. Supervisors have weekly meetings managing their political risk on Capitol Hill. That was the meeting. I could never miss that meeting as chief economist. Which person on Capitol Hill were we worried about? And how were we going to manage that risk? The second problem, so the first problem is asymmetric incentives to act, that is, lots of incentives not to act, combined with unlimited discretion with all these measures, it's all private information, no one can hold you accountable. Second problem is the culture of supervision. So the skills, tools, and procedures supervisors are taught come from an accounting background, not an economics background, and not a very good accounting background. So I like to say, and now people are really going to get mad at me in my old agency, that bank supervisors are people who kind of like to deal with accounting numbers but aren't ambitious enough to get a CPA. Right? So,
Avoid your eyes.
5 minutes, right. I won't need more. So I think that it's true that they don't know economics. The head of supervision, the heads of supervision at our supervisory agencies aren't trained in risk. When I would go to meetings, one of my favorite lines was, risk is not a feeling, risk is a number. And in fact, there are several different numbers, depending on which aspect of risk you want to talk about. So we can actually quantify risk. But you would be shocked to know that despite the fact that economists have all these measures that quantify risk, the people in charge of the supervision that I was working with didn't use any of those measures. And they weren't trained in those measures. They were trained in box-checking exercises of multiple qualitative indicators that don't translate into a single measure of risk. That is, once I said, I'm sorry, I'm getting distracted, but it's a good distraction. Once I said to my colleagues, what level of risk do you think we should be targeting for national banks? Like, should we be thinking of it as we want to make sure that they only have a 1% chance of failure over a 2-year period? Or should we have a 2% chance of failure? Or should we have a 0.5% chance of failure? And they looked at me like I had 3 heads. Like, what does this have to do with our jobs? I said, this is what prudential regulation starts with. What is the goal? And then you can decide all of the tools that you have to achieve that goal. But you have to first figure it out. By the way, guess what? Banks that are smaller systematically are riskier. So we did analysis in the economics department to see, what are we targeting? Well, national banks that are in rural areas where we're really worried about our membership problem, because that's how we get fees, by the way, in rural areas are allowed to be riskier. Of course, large banks, they're allowed to be riskier because they're so politically powerful. It's the middle banks that we have so few of that are kind of in a different situation. Okay, so the culture of supervision is all about box checking. So the combination of asymmetric incentives with unlimited discretion and a culture of non-economic thinking means that supervisors basically love to delay and don't ever talk about failure risk. So now, I'll tell you what my paper says without going through all of it. It says that we can use market information and economic analysis. I know we can because we did it in the economics department at the OCC, but we never were able to actually implement it, to come up with measures of real economically based measures of things like the risk of failure, which could be used through regulatory standards that would use, let's say, market capital ratios or contingent claims mechanisms I've described before this audience before, to create regulatory outcomes that depend on the economic value of bank risk, the economic value of bank capital, and that allow us to have regulatory standards that aren't these weird accounting treatments of balance sheets. By the way, banks aren't balance sheets, they're service companies. Can you imagine if you were telling Microsoft that you were going to decide its leverage based on its tangible assets? How stupid would that be? Very stupid. Well, that's what we do with banking, of course. That's the whole game. It's all about their balance sheet. So we need to have market-based analysis of these companies as service companies to set regulatory standards. And then we have to have accountable supervision, which means a bottom line measure that supervisors maintain on their dashboard of the likelihood of default of the bank, and a timeline that requires that when that measure gets sufficiently underwater, that is set a critical threshold, that they actually have to act or explain. That puts the accountability on them, make it transparent with a lag so that we can actually hold them accountable, give them a criterion, give them accountability, and they will succeed. Thank you for your attention.
Would like to welcome Debbie. I have the clicker if you need to advance any slides, Debbie.
Thank you, Greg. I have my own clicker,
Perfect.
so it's in my computer's control. And hello, everyone. I'm very sorry that I'm not able to be there with you today, but I'm very happy to have this opportunity to talk about the Basel III Endgame. And I think it's sort of fortuitously my comments and Charlie's are very complementary. I'm getting in a little bit more into the guts of what happened with this proposed new regulation. So the Basel III Endgame refers to a sweeping set of proposed regulatory changes that would significantly increase bank capital requirements for large banks. It would raise G-SIB surcharges, and it would replace the tailoring of regulation with more standardization, which would be convenient for the regulators. In the face of what turned out to be near unanimous opposition from the industry, the so-called Endgame has now gone into extra innings. Chairman Powell, testifying before the House Financial Services Committee, said, "We do hear the concerns, and I do expect there will be a broad material changes to the proposals. I'll add that I'm confident the final product will be one that has the broad support at the Fed and in the broader world." So it'll be interesting to see what changes come out of that. That's a pretty big promise. Okay. I think the heart of the problem with the proposed regulations and what gave rise to all the opposition, and also the broader theme of my remarks this morning, was very eloquently described by our lunch speaker, Governor Bowman, in the opening sentence of the statement that she published last July, explaining her dissent to the proposed rule. And I have it up on the screen, hopefully. She said, "The first proposal under consideration would substantially increase risk-based capital requirements for banks with more than 100 billion in assets. In my view, there is insufficient evidence that the benefits produced by this proposal would justify the costs." And the emphasis is my addition, because that's what I'm going to be focusing on. She goes on to say the proposed revisions under consideration have not been directed by Congress and are not compelled by new evolution or identified weaknesses in the US banking system. Although this proposal is intended to implement the Basel III agreement, in light of the many deviations from internationally agreed standards, it's not clear that today's proposal would improve international consistency and capital requirements for large internationally active banks. So that was, I couldn't have said it better. But let me say a little bit more about the proposals. A variety of organizations have estimated the net effects on capital requirements for different institutions. While not everyone agrees on the details, all conclude the effects are large. I've borrowed some slides from the very detailed analysis of the law firm Davis Polk to provide a sense of what was proposed. So let me move on to my next slide. And I don't expect anyone can absorb everything that's on it. Maybe one of the things I wanted you to take away from it was the enormous complexity. And that complexity is actually arising from the huge complexity of existing standards. So to understand the incremental effect, not only would you have to understand the proposal, but all the intricacies of the existing capital regulations. But in any case, I would summarize it by saying the main impact of the proposed regulations is on how large banks must calculate their risk-weighted assets that go into the capital calculations. With regard to methodology, there's a move towards standardization. The largest banks that previously were allowed to use their own models for risk assessment will be forced to use the Fed's enhanced risk-based approach instead. Another change is that the market-based rule would be replaced with one that takes into account both market risk and counterparty risk, which is especially relevant to banks with broker-dealer subsidiaries that are making markets. Back to moving a slide forward. Okay. So what is the bottom line of all of this? Well, the bottom line for capital requirements is they increase for large banks, as we've said before, with the biggest changes for the largest banks. Common Tier 1 equity would increase by an estimated 19% for the largest Category 1 banks and holding companies. That would include the GSIBs and banks with more than $700 billion in assets. The increase for mid-sized banks between $100 billion and $700 billion, and that includes regional banks of recent concern, would be much smaller at around 6%. It's worth noting that this is clearly much less than would have been needed to save the regional banks that failed last year because of exposure to interest rate risk. Well, I want to stop sharing so that you can see me in large size. I don't know if that's a good idea, but we'll go for that. I have no more slides. Okay, so let me first briefly comment on the wisdom of what might seem in the weeds, but I don't think it is, which is the methodological change that revokes the option for the largest and most complex banks to use their internal models for evaluation of risk. So again, in its place, banks would be required to use the Fed's proposed new standardized model. But I've spoken to a number of formerly high Federal Reserve officials about this, or current Federal Reserve officials about this, and they justify the change by pointing out that it was very hard for regulators to evaluate the models, and that the models produced a wide range of risk estimates for institutions whose risks on the face of it probably were not as dissimilar as the model predictions indicated when they used their own models. Well, my view is that this proposed change is ill-advised. You know, it's imperative for the largest banks and bank holding companies that both regulators and bank managers develop a deep and dynamic understanding of the many risks and their existing mitigants. Regulators lack the resources, the information, and referring to Charlie's comments, very often the expertise to adequately model the complicated risk exposures of large bank holding companies. Allowing the banks to use their own risk modeling encourage investment in those models, and I think that's important because in turn, that will allow the banks themselves to better understand their risks. The bank models also serve as a tool for educating and communicating about risks with regulators. A simpler standardized approach means that to protect against the adverse events not captured by a simple standard model, capital requirements on average are going to have to be higher for all large banks. Now, to the extent that higher capital requirements impose real costs on banks and their customers, an increase in average capital requirements has a social cost. I'll mention as an aside, that's something that's confusing to regulators. Oh, well, it's confusing to academics. And certainly not well specified by regulators or by the industry, is exactly what the cost is of capital requirements. But I'll come back to that. Okay. Well, and lastly on this topic, I think it's important to imposing a simple standard model reduces the incentive of banks to control risks that are outside of that standard model, that they're not rewarded for curtailing. Okay, anyway, that's probably not the most important point, but I wanted to say that because it hasn't gotten, I think, as much attention as it should, as it deserves. It's something where academics, I think, can usefully weigh in. Industry is probably less concerned about it. But more broadly, do the costs of the higher capital requirements justify the benefits? The unprecedented outpouring of opposition from the financial industry, along with the substance of their analyses, suggests they probably don't. Interestingly, in a Brookings paper about the Basel III Endgame and Fed independence, Peter Conti-Brown puts it like this. He says, as a historian of US banking, I struggle to identify a time when banks fought harder against a regulatory decision than this one. Nothing in the Clinton or Obama administrations comes close. We have to look back to the New Deal when President Roosevelt declared in a campaign speech that bankers were unanimous in their hatred of his program. And even then, it wasn't quite true. So along with the opposition from industry, as I mentioned earlier, there was opposition from Governor Bowman, but also Governor Waller, and also from 2 of the FDIC commissioners. So as a quick aside, I want to note that my colleagues on the SOMC often lament the lack of dissent at the Fed with regard to monetary policy. So maybe it's encouraging that at least in the regulatory arena, there is the willingness to publicly take opposing views. Well, personally, I haven't seen enough evidence or have the capacity to evaluate the evidence to have a strong view on whether the overall benefits of increasing the capital requirements exceeds their costs. But much more importantly, I think the Fed also appears not to know the answer to that question because it did essentially no cost-benefit analysis, or at least none that it was willing to make public. Now, one can only speculate on the timing of the rollout and why so little analysis appears to have been done or presented. Maybe there was a rush to get out a strong regulatory response to the regional bank problems to deflect criticism. If that was the strategy, I think it backfired because the proposed measures were generic and clearly didn't address the problems with regional banks that Charlie spoke about earlier. It was disappointing to me, though not surprising, that the tightened market risk calculation still fails to explicitly take into account easily measured interest rate risk exposures, and that the measurement problem arising from the way held to maturity accounting distorts value was ignored completely. Anyway, the idea that these rules were by way of simply finishing the implementation of Basel III was also unconvincing. As Governor Bowman and many others have noted, the proposed rules do not conform to Basel III, and part of the controversy, in fact, is that they are more stringent in certain key respects. So the gist of the many objections is that the capital requirements were layered onto existing rules without consideration of whether they were duplicative of existing protections for specific risk. The Fed didn't provide evidence. For example, they could have done additional stress tests to show this was necessary for a particular risk. So they didn't provide evidence that the existing levels of capital were inadequate. A concrete example that I'm quite familiar with because I'm on the board of the Chicago Mercantile Exchange, and this is one that drew fire from the entire derivatives industry, is the additional counterparty risk adjustments levied on broker-dealer operations of bank holding companies. That was a mouthful, but the proposed additional capital required for derivative counterparties is completely insensitive to whether the risk is already largely covered by provisions like margin requirements or collateral. and it's substantial. The industry argues that this will increase the cost of intermediation in the derivatives markets. It will cause some to exit the business entirely. Beyond increasing customer costs and discouraging hedging, it will work, ironically, against other regulatory goals, such as promoting central clearing or maintaining liquidity in the non-bank financial marketplace. So the Fed's freedom to promulgate regulations without a supporting cost-benefit analysis arises from its classification as an independent agency. Cost-benefit analysis is required for all federal agencies by an executive order. The order was issued back in 1993, and it has remained in effect since that time through Democratic and Republican administrations. It requires that an analysis be undertaken and recommends that regulations with the greatest benefit relative to their cost be selected. However, it does allow latitude based on other factors. It's interesting to me that the SEC, which is also an independent agency and so exempt from these formal requirements, actually voluntarily adopted the regular use of cost-benefit analysis a number of years ago after losing several important and embarrassing court cases where evidence that costs exceeded benefits were used to strike down some of its proposed regulation. The FDIC is also independent, but its Inspector General has actually published a report critical of the inadequacy of its cost-benefit analyses. As the Congressional Research Service has noted, there's growing pressure in Congress to extend these requirements to independent agencies. So the question probably of interest to this group is, does Fed independence require an exemption from the mandate to perform cost-benefit analysis of its regulatory policies? I would argue not. The privilege of independence is justified by the need for monetary policy to be insulated from short-term political pressures, and specifically to give the Fed the latitude to take the politically unpopular action of raising interest rates when the macroeconomic situation calls for it. But it's much harder to make the case that the Fed's regulatory responsibilities require more insulation from political pressure than other federal agencies. In fact, and this is really important, and I think Charlie was saying the same thing, exactly the same thing. Regulation is intrinsically involves political decisions. In this case, the tolerance for risk in the banking system and the trade-offs involved are not something that can be resolved based on expert judgment alone. Experts have opinion and experts disagree. Arguably, cost-benefit analysis would strengthen the credibility of the Fed's regulatory decisions and thereby help protect its independence. So certainly cost-benefit analysis is not a panacea. Countless ill-advised regulations are adopted by agency, maybe every day, that are subject to this rule. However, the act of attempting to quantify cost and benefits is illuminating. Even where precise measurement is impossible, a formal analysis can provide a much clearer idea of the order of magnitude of effects. And I think actually the Fed does not understand the order of magnitude effects of its capital regulations. And the very act of enumerating costs and benefits and trying to quantify them can lead to voluntary curtailment or restructuring of bad policies before they reach the public eye. These important advantages are recognized by the bipartisan support for the rule that has lasted for decades. So just a final observation is that a trademark position of my colleagues at the SOMC is to favor rules over discretion, rules over discretion. So I think that routinizing serious cost-benefit analysis on the regulatory side is completely in the spirit of this idea that we should have rules rather than discretion. It would provide discipline and transparency to Federal Reserve policymaking. Thank you very much.
Well, let me just thank Charlie and Deborah for incredible presentations. As always, I'm in awe whenever they weigh in on these topics. I know Charlie wants to start off with a quick comment, and then I'll start taking questions from the floor. Please.
Yeah, I really loved Debbie's presentation and agree with it wholeheartedly. But I'd like to reinforce her observation with a couple of facts. So the beginning of a cost-benefit analysis that would do what you're saying, I think, the beginning of it, not the end of it, but certainly part of it, would state what the target risk level is that the prudential regulations are trying to achieve. That is, that they would say what I have always noticed, we have never had our regulators say, which is our capital requirements are designed to target this level of risk. Just like when Moody's has a bond rating, we know what that translates into in terms of default risk. You know, triple B, well, maybe that's a couple percent. Single A, that's 1% over a couple of years. So everyone understands when people talk what the rating translates into because it's related to an actual risk. So why is it, Debbie, that Basel and our regulators have never said we're targeting this level of risk? And the answer is because a statement like that would immediately limit their discretion. A statement like that would immediately create accountability. They don't want either of those. And so, since no one has made them, Congress has never made them do that, they of course won't do it.
All right.
And wait, one other comment.
Sure.
So what about the models risk? So what we knew from the beginning was the New York Fed found 20 years ago that the best predictor of bank loan risk was the all-in interest rate charged on bank loans. And that it was much better than other kinds of models of risk. And then academic studies have found since then that the models that the banks use are always predictably on the wrong side of measuring risk, as they underestimate it, and that they would always be, a superior measure of risk would have been the all-in interest rate charged on loans. In other words, banks charge for risk, they get compensated for it, and it's a pretty good measure of risk, which we never would use in regulation or supervision. Why? Because it might limit our discretion, and it might make us accountable. So I'll just stop there.
I think somewhere in there might have been a question, Deborah. I'll leave that to
No,
you.
it wasn't a question. It was it was showing
So
how
I
the
just
link
want
between
to
our two.
comment. I just want to comment that I believe that having to calculate the benefit part of cost-benefit analysis is even more important than saying what your risk tolerance is, because your risk tolerance can only be justified by the benefit from that level of risk. So I would argue that you have to say the amount of risk you think you're curtailing in order to calculate the benefit, but then you also have to discuss what are you gaining from that incremental reduction in the probability of a bank failure. So I'm going to say that my proposal subsumes what you're complaining about in terms of forcing that to be discussed. And, you know, as I said kind of at the end, you know, regulators have discretion. They might have too much discretion, and Congress could pull back on that, and I wouldn't be sorry if they did in many instances. But the fact is that discretion isn't eliminated by disclosure. I think when agencies get in the habit of disclosing, they find out it's not as painful as you might think. I mean, an interesting history of cost-benefit analysis in the government is it was initially kind of hostily received by Democrats because they thought that it was a way, in fact, of curtailing regulatory power. But I think a lot of Democrats came over to the side of thinking, well, in fact, it's kind of useful because it does help us sell the regulations that we think are important. So I share some of your frustration, but I think that the simply changing the rule to include independent agencies would be a pretty interesting small step to changing the Federal Reserve culture, which is to be imperious about declaring that something is necessary.
We agree.
We have some questions here. We'll start here with Andy, and then the second one in the back. Please, Andy.
Well, first of all, can you hear me?
Let's keep going.
First of all, thanks.
I hope okay.
Now can you hear?
Because I say I can't hear unless you have the mic. Okay.
Can you hear me now? Okay, good.
Yes.
Amazing. Charlie and Debbie, both congratulations. This is just, and even for a non-banking person like me, this was really compelling and fascinating and crucial. I just want to cite, Debbie, you read it. I want to read it again. Governor Bowman's statement from last July. The proposed revisions under consideration have not been directed by Congress. Okay, so my question for the two of you is, the Supreme Court has been taking a pretty fresh look at independent agencies and how they function. And this is a long wave, this has been, decades and decades of kind of Supreme Court, rulings that pile up and then they start to rethink. But I think that my understanding of what's been happening more recently is a rethinking of how much discretion should regulatory agencies have and the extent to which they really need to work at more specific direction of Congress. And so I'm wondering here, Debbie, you raised this, but it was even more in Charlie's comments, like, to what extent is the Federal Reserve susceptible now to a court case that brings all this to the Supreme Court, and the Supreme Court says, we agree that the Fed has independence on monetary policy, but on the regulation, they have to work just like every other independent agency. They have to basically work at the direction of Congress, and that would really start to constrain the Federal Reserve going. So this is a question, okay? Is that something that we're going to expect to see in coming years?
So I ran the Hoover Institution's program for 6 years with Alan Meltzer and Mike McConnell and Ken Scott on the administrative state, its growth, and all of these constitutional questions too. I don't have a short answer to your question, except I would note that certainly Neil Gorsuch is known for, as a judge, not as a Supreme Court justice, but it's likely it will continue, of having some deep questions about the degree of delegation that's happened. And there's this legal history, the Revlon case being the most important one, and I think a lot of people believe it's ripe for reversal, which basically, the Revlon case basically said, Chevron, yeah, thank you. Chevron. I'm old now, so thank you for that. So the Chevron case basically said that if regulators say that they need to do something, we defer to them. But again, we have the Administrative Procedures Act that requires that formal rules, at least, go through a certain process. So that constrains them. So it's a little bit complicated. It's hard to know, but I think your instinct is right, that we're starting to see a bit of a backlash against too much discretion over rules without the discipline of being able to connect it to the legislation. And bank regulation, I think this whole thing, you have to, but it's not a coincidence, right? This was by intent. Dodd-Frank could have specified some capital regulation. It didn't. Note that. It didn't. Congress likes to speak out of both sides of its mouth and not actually have to make the rule and then tell the rule-making agencies that they're going to do it, right? So the hard part is the founders of our country never would have imagined that the legislative branch would not jealously guard, those were their words, its powers. And yet we're living in a country right now where the legislative branch does not want power. That's weird.
Debbie, any thoughts?
Yeah, I think there is a groundswell of support for reining in regulatory power. I think, as I said in my comments, I think it's very important that every other agency that isn't deemed independent does now have to do more, and when they don't do more, they get called to the carpet for it. So I think there's a good chance that the independent agencies might be forced to do more cost-benefit analysis, basically. I mean, I don't think, saying they're going to be reined in by a set of prescriptive rules, I think that's just unrealistic because their mandates are just too broad. And Congress doesn't have the ability, or it could, but it would do a bad job of it, of trying to spell out in a huge amount of detail exactly what the point was of the broad regulatory goals. And so, I mean, the reason things were delegated to the agencies in the first place was the idea of getting expertise to the table and providing enough discretion to make reasonable judgments. So I just want to kind of reiterate that I think just that simple act of extending cost-benefit analysis is something that I think is actually likely to happen, maybe by the Supreme Court, maybe by Congress. It could happen in either place, and that the Fed would be well served by moving in that direction before it's told to, as the SEC has.
Thank you. There was a gentleman in the back there, please. Yeah.
Thank you very much for this tour de force and tour de horizon, a terrific conversation. And just to reinforce what Professor Lucas said about the politicization of this, Cass Sunstein's book on cost benefit very much reaffirms the thesis that you presented. I'm just sort of curious by what I didn't hear, because what I heard described by both of you, I'm a Chicago kind of person, was very much of the Tulloch and Buchanan, you know, the bureaucrats, the supervisors are seeking to protect themselves. And so in fact, your political economy argument, it's really politics without romance on this. Mm-hmm. And so I just want to get clarity on this. Is the basic agreement of the two of you is that these regulators and supervisors are acting in their best interests before the interests of the systems they are to supervise. Speaking as an MIT person, as a model builder, the idea that you create a monopoly model for managing risk is prima facie unwise.
Let me take that one. I guess as a Chicago person, I think of myself as solidly a Chicago person. But I do think I guess at Chicago, what I thought I got out of my education at Chicago was always being very cognizant of the incentives of all parties involved. And I don't think Charlie and I are I'm not saying something quite as strong as Charlie, because I think, to answer your question directly, I think, for one thing, regulators are heterogeneous. I think everyone in the world acts in their self-interest, and they sometimes don't understand the difference between their self-interest and the mission that they're given. They kind of tend to convolute the two. But I think regulators sincerely want to do the best thing for the system, but what they think is the best thing is colored by their own risk aversion and careerism and everything else, and that it's naive when economists treat regulators is obviously trying to maximize the social good, because clearly they don't.
I think we agree. Everybody I know who's a public servant who I've worked with, I admire as an individual, and I don't think that they're particularly selfish or greedy or anything like that. There are other, maybe you could say a little less ambitious than people work in the private sector on average. I think that's true. But I think that the key is what Debbie said, is that the incentives will be helpful to them. They need those incentives from accountability and information. Because the problem is that the people aren't trained. Supervisors are not trained to measure risk and put it on their dashboard, and to have a single summary measure or a few different measures. They could have an S-risk measure. They could have a distance to default measure. We can think of different things that are specific finance economics answers to specific well-posed questions. Those should be on the dashboard. They are not. And the people who run that dashboard haven't heard of the measures. That's how bad it is.
Okay. There was another question, please. Yes, right here. Okay. Next one.
Hi, question for Debbie around cost-benefit analysis. I think we would all agree that bringing more rigor to the regulatory process is a good thing, but cost-benefit analysis itself relies on a whole host of assumptions and methodological choices. And we see this, for example, in the current administration, where OIRA has changed the way it uses discount rates to calculate benefits associated with environmental regulations to overstate the benefits of climate-related regulation. So how do you think about bringing rigor to the cost-benefit analysis process itself, and trying to limit the discretion associated with the regulatory state?
I love that you brought that up. I've spent quite a huge amount of emotional energy responding to the proposed discount rate changes, and I was appalled at what the administration did, which was a huge step backwards. So for those of you who aren't following the environmental front, the administration basically imposed a ridiculously low discount rate for all the discounting they do for all regulatory policies and all investment policies, simply because they wanted to make the benefits of climate change mitigation look larger, which is infuriating. But why do I still believe in cost benefit analysis? I mean, it's because we can see that bias. So I talked about that in detail because, I mean, we can see that those benefits are inflated. And even by being forced to write down those assumptions and do the calculations, it kind of shines light on what's driving the calculations of the cost and benefits. I think there's no way to really get them right anyway. These things are enormously complex. What's the value of incremental stability in the banking system? Hard to say, but I think I'm more interested in the act of attempting to quantify and making that somewhat transparent than I am in the difficulty of getting it right. So that was a little convoluted, but those are my thoughts.
So I was in charge of cost-benefit analysis as the chief economist at the OCC, and we do cost-benefit analysis of regulations if the regulations meet a certain threshold. However, the criterion, I think Debbie's point, the way I listen to it, is let's have real cost-benefit analysis with real criteria and procedures that are spelled out in a clear way that are meaningful. Currently, I asked the legal department at the OCC, is this threshold, is that for the total cost on a net basis or on a gross basis, or could it be the total impact of a gross benefit? That is, what does this $100,000 number mean? And the answer is, we don't know. And the different regulatory agencies interpret it differently. So I think we have cost-benefit analysis, but it's meaningless. So to really get to meaningful cost-benefit analysis is going to require establishing some procedures that explain what really is expected so that we can perform up to the standard that I think Debbie has in mind.
Please, next question over here.
Excuse me, Greg.
Oh, yeah, Charlie, yes, please. Yeah, jump in.
Yeah, I'm sorry to interrupt, but
No worries.
I want to make two observations. One has to do with Debbie's comment in the discussion about discount rates. I spent 9 years at the Fed. Part of that time, I was overseeing many large projects and approval of many large projects that the Fed would undertake. The Fed always discounted a discount present value and analysis, and always use the risk-free rate to discount costs and benefits. I used to tell them when I taught capital budgeting to MBA students, if anybody in my class ever told me they were going to use the risk-free rate to discount any and all projects, I would flunk them. And yet it's pervasive. It was pervasive at the Fed, and I suspect, as you were just talking about, it's pervasive everywhere else as well. So that was one comment. My other comment is I wanted to go back to what Charlie and Debbie were saying. One of the things about the independence of the Fed, and this is an old topic, but I'd be interested in both Charlie and Debbie's reaction. One of the things you might infer from this conversation is that to preserve Fed independence, we really need to disentangle banking regulation and supervision from monetary policy, and to take banking supervision and regulation out of the hands of the central bank. And that would be a great benefit, perhaps, to ensuring independence of, or make it easier to ensure independence of monetary policy. And the conflagration of these two missions at the Fed is potentially very damaging or risky, if you will, to preserving independence. And I just like Debbie and Charlie's reaction to that.
Right.
Thank you.
Keep them short. Keep the responses short, please. Yeah.
Well, let me remind everyone that in 2007, published I think in March 2008, the U.S. Treasury proposed exactly what you said, Charlie. And they were even very careful about it. It was a long white paper that said that the Fed should retain a role in examination, and because of its role in the discount window, but there was no legitimate reason for the Fed to be involved in regulation or supervision. It was an excellent, and it was also calling for a consolidation of regulatory authority in different places. It was, I thought, an excellent white paper. And then the financial crisis happened, and what we saw was that, unfortunately, my friend Ben Bernanke was a very skillful Washington operator and managed to get the Fed's powers increased rather than decreased as a result of the crisis. So we were on the brink of that reform when the crisis happened in 2008 and sent us in the opposite direction.
Debbie?
Okay. I'll be more brief and say, Charlie, I 100% agree with you. Maybe we should write a paper together called Narrow Central Banking
That's a great
rather
title.
than Narrow Banking. And,
I'm all for it.
and then I'll just use my 30 seconds to put in a plug since you brought up discounting. Just recently, I edited and contributed to a set of papers that was published in the Annual Review of Financial Economics on the social discount rate, where a lot of these issues were emphasized. My own work for the last 25 years has been trying to get governments to put risk adjustments into discounting. So, it's a really nice collection, and it's free online. So the Annual Review of Financial Economics, for those of you who are interested in kind of the foundations of discount rates in the public sector.
Right, we have
Debbie, I remind you, I gave a speech in 2013 or 2012, and the title of it was A Limited Central Bank. So
All right,
you
please,
can tell where my proclivities lie.
please, Bill.
Thank you. I'm interested in the other piece of the conversation, which is the people running the banks, who probably know the most about the banks and are most incentivized or disincentivized from doing things connected with the banks. It's a big balancing question, right? You could debate incentives to why someone would run a bank or not, and how you can make something sufficiently scary if you're running a bank to have the incentives in the right place. I'm curious what people think about that.
So we have academic literature on the incentives of bank owners and bank managers. And the thing is that, and I'll just say it very briefly, the government policies affect those incentives. So what we found was the more concentrated share ownership prior to 2008 in the banks, the more discipline, in the sense, the more voice shareholders had, the more risk the large bank took leading up to the crisis. So in other words, there seems to be evidence that that the moral hazard problem of trying to get value from the government safety net is something that bank shareholders are advocating when they have more power within the bank franchise. So I'm just saying, I think that it's not that there's a broken corporate governance problem in banking, although there are some problems with it. It's more that the incentives are not there for them to be particularly worried about the things that we are worried about as a society. There really is an externality here. There really is a difference between what's privately beneficial to the bank owners and what's beneficial about their business for the economy.
But for executives, right, clawbacks that took
I'm going to actually, oh, go ahead. Sorry.
You're saying clawbacks that took place as an example.
Yeah, she can't hear you.
I'm sorry.
Can't
I'm
hear
thinking more beyond the shareholders to the executives, right? At the end of the day, if there are clawbacks involved or things where the executive says, well, look, the shareholders want one thing, but I'm here to tell you, right? That's what I'm more interested in.
Please, Debbie. Please, Debbie.
Yeah. So that is what I want. This is a place where I think Charlie and I actually don't agree. I think for the most part, executives of all corporations have a large incentive to be risk averse because their jobs are on the line. And so, it's not so simple as you have the safety net that causes banks to want to take more risk. In fact, the original Merton 1976 paper on the pricing of deposit insurance using an options pricing framework also pointed out that when banks have franchise value, they're actually in a situation where the incentive is to be protective of that franchise value, not take excessive risk. And so you can actually see when you look at the technical analysis, as banks get less solvent, the kind of risks that Charlie is talking about, the kind of incentives become salient. But for banks where that option to put losses on the government is out of the money, it's just not that big an incentive. So I'm going to say that I actually think that these financial institutions, for the most part, have a huge interest, and especially the management, in managing risk, and they would do most of it anyway, and they do it in a much more intelligent way than the way the regulators look at it. That's my perception, and partly from being so involved in a particular what's called as CME is a SIFMU, and when I look at their understanding of their risks and the way they manage them compared to perhaps what well, I won't say that. Their regulator is very good too, but I think their level of sophistication is extremely high, and you see, I think when you go into any financial institution, you do see a lot of attempts at risk management. So I don't actually put as much weight on the regulation in any case.
All right, we're going to move on to the next question. Mickey's got one, then there's one in the back there with the gentleman standing. Apologies if I've missed anyone. Please. Quick,
Debbie,
quick. Shorten it up,
okay.
everybody.
I have a
Chris.
practical question. Debbie, you mentioned the limitations of the stress tests. And before I ask you what you recommend we do on the stress tests in general, I just want to make a comment on the other gentleman's question, point about banks. I think banks, and I think stress tests have provided a tremendous incentive, at least for the SIFIs, to manage risk better. I worked at a too-big-to-fail bank. Going into the financial crisis, the executives, including the CEO, had no clue what was in their portfolio. They had no clue about the flows. They had no clue about the risks, and they didn't have any. I could go on. But post-financial crisis, the imposition of the stress test dramatically increased the incentive for the big banks to actually understand what was in their portfolio and actually develop risk metrics. So Debbie, the stress tests, and we could just observe that the last stress test in 2023, Silicon Valley Bank would have passed just fine. What would you recommend for modifying the stress tests to modernize them to different types of risk?
So actually, I just, in my comments, I was actually recommending that the stress tests, in fact, are a step towards cost-benefit analysis because they give you a sense of the size of the risk exposure. So at least you can at least demonstrate, well, we're taking away this much risk with this much more capital. I don't have a concrete proposal for what to do with the stress test. I think a lot of people commented that in the case of SVB, the problem was that the Fed didn't consider the possibility of a very large increase in interest rates. And so that's always, they were worried. They thought that recessions are correlated generally with cuts in rates, so they didn't think about a stress scenario where rates were going up. I think probably the regulators have learned that lesson, and they'll tailor their future stress tests to take that into account. So I agree with you that stress tests are useful. I think you need to choose your scenarios wisely, but I don't have anything more to say about it than that.
Charlie, briefly.
Quick comment.
Yep.
I agree with both of you that having stress tests improves the conversation within the regulated entity, and that's the main benefit of it. The problems with the stress test, I would say, are two main problems, which other than that, Mrs. Lincoln, how was the play? The first problem is the scenarios aren't meaningful. And that could be improved by making the Fed and the OCC, that does a separate stress test, accountable by having some kind of independent group of academics simply commenting publicly on the stress test in a way that would still allow it to preserve the specifics, the secrecy of the specifics. So the stress test is not accountable and therefore probably not very good. Secondly, the criterion for success is wrong. The criterion is how you emerge from the stress test, what's your tangible equity ratio? That's not, so suppose you're Citibank, and for most of the last 14 years, your economic capital ratio is less than half of the value of your tangible equity. Okay, I'm just pointing out, book values are not very useful. And so the stress test still uses tangible equity, For JP Morgan, that underestimated JP Morgan's strength because their economic value of equity after their stress test was 50% more than what the Fed gave them credit for. For Citibank, it was 50% less. So it's just like, this is pretty simple, right?
Okay. There's a gentleman standing there. We're just cutting into our break, so he'll be the last one. Then we can have a more informal conversation during the break. Please, last question.
Hello. So people have been talking about the agent problem for bankers or regulators a lot, but earlier you mentioned the legislators, and they have a serious problem too in terms of wanting to block any moves towards cost-benefit analysis or this sort of weaker Fed, because one of the most important problems for a politician is blame management. Mm-hmm. And so long as they can delegate the actual pushing of their policies to regulators, they can just quote-unquote lobby regulators to pass the real laws they want, make sure the regulators take the blame, and their hands look clean, even if they're not, even if they're always whispering in their local Fed governor's ear to change the policies. It looks like they haven't done anything because it was not on their books. So, like, how can you address that in order to get to a weaker Fed or actual cost-benefit analysis?
I can answer it quickly. It's very hard to address because, as I said, our framers depended upon the notion that the legislature would jealously guard its power to actually set laws, right? And they don't, because the private incentives of the individual members are to not be specific, not be anywhere near specific. And so I think you outlined exactly what the incentive problem is. We don't, the three branches of our government are supposed to compete for power, not supposed to try to force the other branch to take power. We don't have a mechanism for that.
All right. I think with that, we will go straight to break. Wonderful to see you, Debbie, if only virtually. Thanks. Great job. Thanks, everybody. I think we got a lot in.
Yeah, I think so.
I'm like,
just swap chairs.
Okay, I'd like to welcome everybody to the second panel, which is entitled The Monetary Policy Framework, in contrast to the first panel that was on the Regulatory and Capital Framework. Okay, so how do I begin? Very shortly. You know, following what I think of as Fed blunders, which contributed to the highest inflation of 40 years and subsequently required the most aggressive rate hikes in 4 decades, this panel is going to consider key aspects of the monetary policy framework. What should the Fed be considering as the best framework for achieving its dual mandate? The Fed seems to have lost its way in forecasting inflation. The new normal that it postulated prior to the pandemic, in which lower unemployment was consistent with low inflation and low real interest rates, that is, lower natural rate of interest, seems to have disappeared. The Fed's earlier perception of a flat Phillips curve is now being questioned even within the Fed. What's the shape of the Phillips curve? The Fed seems to have also lost its way in forecasting the real economy in the last year, as the economy has significantly outperformed, really in a dramatic fashion. So how should the Fed frame its monetary policy for achieving its dual mandate? So this panel, we've got a great panel. It's going to begin with Athanasios, Orphanides, and Peter Ireland talking about monetary policy in the current environment. And then Jeff Lacker and Andy Levin are going to speak about the structure of the Fed and some governance issues. So Athanasios, please.
Thank you, Mickey. It's a pleasure to be here, and especially having Governor Bowman already attending this. As you introduced the topic, Mickey, so this is the 5th year of the Fed's doing a lot of work for the 2020 policy review. That review took place mostly in 2019. So I'm one of the people waiting for the transcripts to be released for 2019 next year, so that we see how that went. And as you pointed out, let me see, it didn't quite deliver the outcomes that we would have expected. If we put the performance of the Federal Reserve in historical perspective with the price stability mandate, which I thought had been handled reasonably well for about 30 years, was not working very well. So in a sense, the framework did not prove as resilient as we would have wanted it to be. In particular, in 2021, as we know, the Fed used this discretion, and this is going to be the key word here, discretion, to peg the federal funds rate at 0 for too long. You can see this here on the orange line on both panels. And what was quite surprising to people on the shadow and many others watching this is that you could see inflation rising, you could see inflation expectations rising in real time. This was not something that was hard to see, and yet the Fed was not doing anything. What this translated to is the most negative real interest rates that we have on record when we track financial data of this nature. This is ex ante 1 year and 2 year ahead real interest rates. So the question is, how can we move beyond this? Well, in my view, the error that we saw in 2021 represented a notable deviation from principles that the Fed had espoused in the past. The Fed used to say very clearly, at least since the early 90s, that it was forward-looking in order to be preemptive in its policies, and tried to be systematic. And actually, the Fed did quite a bit of work trying to introduced monetary policy rules in the policy report. There are principles about what the benefits of systematic policy are on the board's website that were not there 20 years ago. And yet somehow policy was not as systematic as it could have been. So what I would like to propose in the next few minutes is that it would be useful for the Fed to go back and think how to improve the systematic nature of monetary policy. And I think we know how to do this. We know how to do this by espousing simple policy rules that we have been working on for the last few decades. And you will recall this vast literature, I would say, started with Ben McCallum, who was on the shadow in the 1980s with simple rules based on the monetary base. Then we have the revolution that followed the classic paper by John Taylor, and a lot of work since then that could actually guide us quite a bit. So what are the desirable characteristics of rules? We know what these are. If I can have this move. Oh, okay. We want a rule that is forward-looking, that preserves price stability over time, that is somewhat counter-cyclical, and that is robust to some of the many elements of imperfect knowledge we have, including star concepts. And I want to show you a simple example about how we could start thinking about this. Simple example is going to be simply based on a comparison of what we think nominal income is going to be in the next few quarters compared to what normal nominal income is. This is, if you look at the variable, I will have a growth gap. If you think nominal income is going too fast, you should just tighten policy a little bit. If you think nominal income is moving too slow, which is usually what happens in recessions, you should ease a little bit. It's not complicated. This is a one parameter difference rule, and I will show this to you in a minute. I will actually show you an example using the Survey of Professional Forecasters projections that the Philadelphia Fed is publishing quarterly. We can use that projection to see what is the expectation of nominal GDP growth starting from the previous quarter, which is the last observed quarter we have, 3 quarters out, so a year ahead, and then compare this to some estimate of normal. Now, the Fed could do this with its own estimates of normal. I don't have those; they are not available in real time. For the illustration, I will show you in a minute. I will rely on the survey question on what the expectation of real GDP is going to be over the next 10 years, adding a 2% inflation, which is consistent with the Fed's objectives. So very, very simple. You can use the data. You can construct this. You get these inputs to the rule. The blue line tells you in every quarter what the projected nominal GDP growth would have been based on the SPF. And the natural growth rate is the estimate of potential real GDP plus the 2% target. It's very, very suggestive. When you have a recession, as we have 3 recessions in this sample, you would want the Fed to be easing policy. And when we have this massive explosion of nominal GDP, which is what you see after the pandemic, we would have wanted to see the Fed tighten policy. Now, I'm going to show you a picture of what this would suggest. We can estimate this, we can compute this rule. There's no estimation involved here. We can compute this very, very simple rule asking the question, what if on a quarter-to-quarter basis, you take that gap, you multiply by 1/2, and get a prescription for what the quarterly change in the federal funds rate would be like. What would that counterfactual federal funds rate look like? And you get something like what you have on the left panel of the figure. What you see is that overall, broadly speaking, the Fed hasn't been deviating massively from this very simple rule, and policy wasn't that bad from the 90s until right after the pandemic. And then right after the pandemic, you see this massive deviation where nominal GDP was screaming at everybody, we need tighter policy in order to make sure this is not getting out of hand, and yet the Fed was being too discretionary and did not adjust to that. So this is really a very, very simple illustration. Now, I would have liked to show this to you with projections that we have from the Fed, and we can't quite do that, but I will show you something similar to that. The staff projections are always released with a 5-year lag, so we don't have everything available. But we do have the SEP, so I will show you an exercise based on the summary economic projections median estimates. The SEP does not provide projections for nominal GDP. You know, this is a beef people like Mickey and I have. The Humphrey-Hawkins projections used to provide nominal GDP as well, and that was axed. But we do have core PCE projections that we can use and real GDP projections that we can use, and we can combine those projections to get something similar to that. We can also use Okun's law, same way that the board staff is using it for the rules in the monetary policy report, and have a version of this rule that is tracking the short-term projection of inflation deviation from target and whether the unemployment rate is rising or falling. Remember, this is a growth rule. You don't need any stars to compute this thing. If the unemployment rate is projected to rise, as has been projected in the latest SEP, from Q4 of last year to Q4 of this year, we have a meaningful increase in the unemployment rate in the projection. That actually would suggest the need for some easing. But if your inflation projection is above the target, you would want to tighten. And you need to just balance these two elements. So I will show you an illustration of this based on the latest SEP. You just have the table. These are the median SEP projections. You can literally just take the median numbers there and compute the quarterly change that is implied by this simple policy rule. Two variants. Both of them use the core PCE projection. One variant uses the GDP growth projection compared to the long-term GDP projection that the committee is providing to us. The other one is using the projected change in the unemployment rate. And you see that the two are not the same. There are some discrepancies. If you use the unemployment rate version of the rule here, you will see that the prescribed change for 23 Q1, the January and the March meeting combines, was 0 basis points, which is exactly what the Fed did. Why is that? Because of the projected increase in the unemployment rate that is compensating exactly in this case the fact that the inflation rate is still above target. If you are to look at the real GDP version, however, you are going to notice the median SEP projection for real GDP was upgraded quite a bit from 1.4 to 2.1 for 2024. That actually would have suggested that you should be tightening policy, and this is what creates the discrepancy. So we can do this in every in the first quarter of every year. We can do this. We can compute these versions of the rule, and we can compare them with the version of the rule that is based on the SEP projections. You can see very clearly here since 2012. The versions of the rule, they are not that far apart. You know, if you have 50 basis points, I'm okay with that. If you are 50 basis points away from a simple rule as this for a couple of quarters. I'm not okay with this if you are 200 basis points away, which is the problem we had. So according to these simple calculations and simple rules, both based on the Service of Professional Forecasters projections and also based on the SEP, the Fed should have been tightening much earlier than it actually did, at least a year earlier and massively. You are going to also notice here that having not done that in 2021, according to this simple rule, the Fed moved too fast in the last few quarters. So late 22 and early 23 was moving too fast, just trying to make up for the fact that it had not done it before. And that, again, that's not a reflection of systematic policy either way. Bottom line is the Fed's policy strategy proved insufficiently resilient. Part of the problem is that it relies too much on discretion. Even though the Fed is talking a nice game about being monitoring policy rules and so forth, apparently it has not been really taken them into account. In my view, the resilience of the Fed's framework would be strengthened if the Fed paid more attention to simple policy rules that Fed staff have been tracking, as a matter of fact, in the last few years, that would have avoided major mistakes, which is exactly why we're looking at simple rules to begin with, based on what Ben McCallum used to tell us at these meetings and others. Thank you.
Okay, I just have one slide. There's the title slide. I'll play hide and seek and leave the slide for later. In the second part of this panel, we're going to hear from Jeff and Andy about the troubling lack of intellectual diversity at the Fed Reserve. In order to draw a link between their comments and Athanasios's, what I want to do is to focus on a specific manifestation of that lack of diversity, which has to do with what I would call a kind of poverty in the range of analytic approaches being used by Federal Open Market Committee members to evaluate their monetary policy options and to explain the rationale for their decisions to the public. So let me briefly explain. The dominant analytic framework for monetary policy evaluation at the Fed is, was, probably always will be the Keynesian one. So according to the Keynesian story, the Fed conducts monetary policy by managing interest rates. By manipulating rates, the Fed can induce households and firms to rearrange their spending patterns over time. And then those shifting spending patterns impact on today's rates of aggregate resource utilization, like the output gap, the unemployment rate, and so on. And then finally, working through a Phillips curve, changes in unemployment, let's say, impact on inflation. So within the Keynesian model, the Phillips curve plays a key role in helping us understand and explain how it is that monetary policy actions that begin by affecting interest rates ultimately impact on the economy as a whole. So it's not that surprising then that applying the Keynesian framework to explain and understand what the Fed has been doing and why becomes more challenging during periods of Phillips curve instability. So let me just highlight the two most recent and glaring examples. Over the decade-long recovery that followed the 2008-2009 recession, the unemployment rate gradually fell and ultimately reached levels that by historical standards were really quite low. The Phillips curve would imply that those low rates of unemployment should have worked to push inflation all the way back to the Fed's 2% target, but inflation never quite got there. And then second and more recently, the Fed's been working hard to bring inflation back down after the unwanted surge in 2021-22. According to the Phillips curve, that kind of disinflationary program should not be possible without having to tolerate a period of elevated unemployment. So far, at least, though, inflation has come down without a significant increase in the unemployment rate. Now look, Phillips curve instability, it does not have to be an insurmountable obstacle to effective monetary policy making. But this is what brings us back to the issue, the problem of no intellectual diversity. Without an alternative analytic framework to fall back on, it does seem like the committee has been left adrift, in a sense, by Phillips curve instability. Committee members have difficulty explaining the rationale for different monetary policy decisions made at different points in time, tying together the intertemporal elements of a broader strategy. And likewise, they seem to have great difficulty articulating what the contingency plans might be if looking ahead something else goes wrong. Either inflation does not continue on its stable glide path back down to 2%, or at the other end of the spectrum, what happens if unemployment does jump higher later on in 2024. Now, fortunately, there is an alternative analytic framework that any individual committee member could take right off the shelf, so to speak, and use to help the committee regain its bearings and communicate more effectively with the public. This alternative analytic framework, it has its intellectual or academic origins in a different tradition. It comes from the monetarist as opposed to the Keynesian tradition. The basic idea is that in pursuing its dual mandate, the Fed should give up on the Phillips curve and simply focus its efforts on stabilizing the growth rate of nominal income and spending, that is, nominal GDP. So just a couple of monetarist arguments to support the idea for nominal GDP targeting. First and most obviously, I mean, nominal GDP, it's a nominal variable. So it's under the clear influence of the Federal Reserve's monetary policy actions. But second, that first point notwithstanding, nominal GDP growth decomposes naturally, as Athanasios showed, into an equally weighted sum of real GDP growth on the one hand and nominal price inflation on the other. So by acting to stabilize nominal GDP growth, the FOMC would be pursuing modest stabilization goals for real economic growth in the short run, even as it preserves long-run nominal price stability. So the way I like to think about it is that by jettisoning the Phillips curve and focusing on nominal GDP instead, the Fed would it would have a monetary policy framework that was more robust, or the term that Athanasios used and I really like is more resilient. True, it would be backing off from some of its ambitions for short-run fine-tuning, but at the same time, it would be guarding against major monetary policy mistakes, like the one that the Fed made in 2021-22. Okay, so how could any individual committee member put these ideas to use? Well, it may be as easy as just making repeated reference to a graph like the one I'm showing on this one and only slide, which shows year-over-year growth in nominal GDP over a period extending back to 2009 and running through the present. Look, this is my main point. The picture, it speaks 1,000 words. If all of you were college students again, and if you were in my class, okay, the thought experiment I would suggest to you is think about going home and explaining to your parents or to your little brother or sister still in high school what the Fed has been doing and why over the last 15 years, referring to the Phillips curve. Okay, it's not going to work. On the other hand, ask anybody who can read a graph, yeah, what do you think's going on here? Gee, I don't know. It kind of looks like things went completely bananas for a few years, but now finally things are getting back to normal. Like, yes, that's exactly the point, right? By making reference to a graph like this one, any individual committee member could reassure the public that the monetary policy actions taken over the last 2 years, raising the funds rate, scaling back on the size of the Fed's balance sheet, are working as intended to bring the growth rate of nominal variables back to more tolerable, more normal levels. Now, one last point. Athanasios is right about this too. The Fed needs to be forward-looking because of lags in data availability, and especially because of lags in the effects that monetary policy actions have on the economy. The FOMC needs to rely on forecasts and not just the data plotted here in this graph. But that issue, too, I think can be finessed pretty easily, again, simply with the reference to the graph itself. Okay? If incoming information suggests that the stable downward glide in nominal GDP growth is intact, back down towards more normal levels, like 4 to 4.5% over the next year or two, then my understanding of the FOMC consensus right now is that American consumers should expect to see modestly lower interest rates later on this year. And that seems about right to me. On the other hand, the contingency plan is important too. If incoming data suggests that the downward trend is stalling out, threatening to reverse itself, then interest rates are going to have to remain higher for longer. On the other hand, if incoming news suggests accumulation of weakness in the economy that threatens to push the blue line back below zero, then interest rate cuts are going to have to come sooner and more quickly than presently anticipated. Okay, so it so happens I think FOMC monetary policy is just about on track right now. That said, I think the FOMC would have a lot easier time. It would be easier and more effective to communicate the full range of its strategy to the public just by giving up on the Phillips curve and focusing on nominal GDP instead.
We will definitely have time for questions and answers. And you know, I'm amazed by our first two speakers. I wish I could have each had them, given them a half hour rather than 10 minutes. So now we're, I guess, kind of shifting gears toward some Fed governance issues.
I take it as well established that group decision making is more effective if it involves serious engagement with a wide range of diverse perspectives. I also take it as well established that Fed decision making over the last few years has not been terribly effective. Athanasios and Peter were eloquent about this. This shows the relatively good experience from 1995 on and the relatively poor performance. My real federal funds rate measure isn't as sophisticated as Athanasios, but tells the same story. Many factors have been discussed, especially here within the shadow, about factors that have contributed to the Fed's poor performance. References have been made already to the effects of the revised framework document adopted in August of 2020, the strong forward guidance that accompanied and explained the implementation of that in September 2020, overestimation of the labor market slack 2021, reliance on the Phillips curve implicitly there, and protocols about asset purchases that involved a commitment not to raise rate until after asset purchases have been completed, and a commitment to taper asset purchases for some reason before ending them completely. What I'd like to argue is that an additional factor is well worth considering at the Fed, that decision making would have benefited by more robust engagement with diverse perspectives. So here's a measure that suggests that the diversity of the perspectives brought to bear in FOMC decision making has been on the decline of late. This shows the average annual number of FOMC dissents per meeting, going back to the Accord in '51. The blue bars are governors, the orange bars are Federal Reserve Bank presidents. Of course, not all of them vote every meeting. So the governors have more chances, more at-bats, as it were. You can see here the way in which Greenspan effectively extinguished dissents by governors in the mid-1990s, a couple exceptions after that. Dissents by Reserve Bank presidents tailed off, and then Bernanke came in early 2006, opened up the committee to some extent, and that combined with the controversial actions taken and policy challenges of the great financial crisis led to a surge in dissents after that. Zooming in on the most recent period, since '06, you can see how dissents have plummeted under Chair Powell, from about 0.7 per meeting under Bernanke and Yellen to about 0.3 per meeting, a dramatic decline. So I'd also mention other evidence of a decline in diversity of views brought to bear on FOMC decision making. There's noticeably less divergence in public statements by FOMC members in their public statements, in their speeches and interviews and the like. You can see this in the frequency with which similar phrases and words appear across members of the committee. The word transitory became notably popular in 2021. Bumpy path is showing a surge of popularity right now. And we'll see how that fares as the year goes on. I'd also mention Mickey Levy at a conference last year at Hoover pointed out the remarkable similarity of the forecasts of FOMC committee members as revealed in the Summary of Economic Projections released on a quarterly basis. So I conjecture two causes of the decline in the apparent diversity of views shown by FOMC members. One is that the Board of Governors is now much more involved heavily in searches for Reserve Bank presidents, and that's resulted in a change in the composition of the presidents that's made them broadly. It's an earthquake, everyone. Yeah, it's occurred.
Yeah, the country did.
I'm told it's a 4.5.
The country.
It's lumpy. It's just something lumpy that just happened.
All right. So I will urge everyone to stay calm and carry on.
Jeff, you have anger of the gods.
I always hope to be impactful. So my second conjecture is that there's been an explicit change in the norms around public communication by FOMC members, and that would make divergent views less apparent in the public. So how are Reserve Bank presidents selected? According to the Federal Reserve Act, the president of a given Federal Reserve Bank is chosen by the non-bank directors of that Reserve Bank, quote, with the approval of the Board of Governors. And that's all it says about the relationship between the two bodies. The name of a final candidate, when a Reserve Bank board decides on who they want, is sent to the board informally for clearance ahead of time before the Federal Reserve Bank board formally votes and submits it. They want to know, is it going to be approved if they vote for it? And then if the board objects at this informal stage, the suggestion is that they reconsider that. Directors can either go about doing a redo on the search, go to a different candidate, or they can dig in their heels. And at times there have been standoffs in which the board and the Reserve Bank board are kind of at loggerheads, and somehow it gets resolved, sort of a war of attrition, I guess. The thing to note here is the chair. One thing to note is that the point person at the Board of Governors on relationships with and interaction with the Reserve Bank Board of Directors is the chair of what's called the Bank Affairs Committee. This is the subset of the governors that's devoted to overseeing the activities of the Federal Reserve banks. And until he became chair, the chair of the Bank Affairs Committee was Jay Pell. The selection process has changed, I sense, starting in around 2010, maybe you date a little bit later. I think that's the right date. The old process is that the process was run by the Reserve Bank directors, and the board had a very limited role until the final approval process. There were check-in calls, say, how is it going, generally, sort of informal calls along the way, but then this final approval process was where they got down to brass tacks and the board had an influence. The new process, I think, is better characterized as board Reserve Bank directors co-management of the process. There are regularly scheduled check-in calls, and these are more than check-in calls. The Reserve Bank directors share lists of candidate pools as they come in. These are, the board provides guidance on individual members of this pool, ruling some out. The board provides its own set of names into the process, and these interactions are fairly frequent. This has been documented by a Bloomberg story recently. My conjecture is that the Board of Governors has used its more active role in presidential searches to steer Reserve Bank boards towards, they would call it mainstream candidates, candidates with a greater affinity for the board's policy views and a disinclination to publicly diverge from this view. In fact, my sense is that that was the motive behind the board's greater involvement in these searches. So I have a rough indicator. It's a rough, it's not perfect, but I would just note that in 2009, over half of the presidents of the reserve banks had records of multiple academic peer-reviewed journal articles in monetary economics and macroeconomics. Now, arguably, this would better prepare one for coming to a well-grounded assessment that differs from that of the majority of the FOMC or from the board or the board staff or the chair. And arguably, it would prepare one better for being willing to question the majority's view, and arguably it would make one better prepared, give one more confidence in stating publicly a divergent view. Now, note carefully, this is a prerequisite, not a prerequisite, just a correlate. There are notable cases of presidents willing and able to dissent who don't fall into this category. But I'd note that of the presidents in this category in 2009, all but 2 had left by late 2021, and those 2 have since gone. Since 2010, of the 13 new presidents hired, only 1 would fall into this category, and that's John Williams, president now of the Federal Reserve Bank of New York. So that's a rough indicator, a rough correlate of a decline in divergence, a diversity of views. Shifting now to communications. There are certain committee norms that have been observed, but these have shifted over time. Under Greenspan, the chair was the sole conduit for monetary policy views. You can see in the transcripts discussions, give and take, were truncated at times. Participants rarely said anything of substance outside the meetings. Bernanke came in early 2006 and promoted transparency and open communication consistent with his academic background, his academic writings, and the views of academic economists more broadly. He provided more latitude for participants to express their own personal views inside the meeting, and you can see that in the transcripts, but also outside the FOMC meetings. And this led to presidents expressing divergent perspectives and governors as well. And I think it clearly aided public understanding, and I think it was a good thing for the Fed, and it's helped the public understand better what the Fed is about. But this has proved sometimes politically inconvenient for the board. Critics in Congress and elsewhere could point to knowledgeable members of the Federal Open Market Committee as their source for a divergent perspective on what the committee's main choices had been. The FOMC now, under Powell, behaves more like a corporate board. It seems as if dissents, if they occur, dissenting views are kept internal, and the committee seems to hew to a generally common message externally, maybe some difference on the number of rate cuts over the coming year, but the differences seem minor relative to the range of possible legitimate views, it seems. And this would obviously have the political advantage of giving the chair greater control over messaging and provide less ammunition for external critics. We have Chair Powell's views on this. When he was a governor in late 2016, he appeared at a Brookings concert, and then the next day at a conference on the subject of understanding Fed speak. And he said, in my view, the public expression of our diverse views helps sustain public support for the Federal Reserve as a public institution. Those members of the public who disagree with our policy should know that their concerns are given choice at our deliberations. So nothing about strengthening decision-making, more effective decision-making. Nothing about public understanding, just that we're affirming to the public that their views are represented. Kind of a more limited political sort of value of communicating external views. He goes on to say, but there's a trade-off here that needs to be managed. On the one hand, the effectiveness of policy is thought to depend on the public's understanding of the committee's consensus. On the other hand, the expression of diverse views may sometimes make it difficult for the public to see that consensus. So this had me scratching my head. When you scratch your head, you go to Merriam-Webster's dictionary, and you find that there's 2 meanings of the word consensus. One is unanimity, and the other is a judgment, or essentially, that the majority have. Well, if they're diverse views, then we're not meaning 1A. We're meaning 1B, where it's the majority's view. So if there are diverse views, and if everyone's expressing their views, including those that are part of the consensus, how much of a consensus is there? But then why not let the public figure out how much of a consensus there is? So discouraging the expression of diverging views would seem to enhance the weight the public puts on the consensus, the majority view. That is to say, since the chair's always part of the consensus, the chair's view. And that may be what he has in mind, rather than rebalancing in some optimizing way for some behavioral missteps on the part of the public in underweighting the majority's view. There are trade-offs in communication regimes. The general presumption in deliberative bodies is that the quality of decision-making is better, more effective when diverse perspectives are brought to bear, and are given serious consideration, are really reckoned with. And this motivated the federated structure of the Fed at the beginning, and it motivated Carter Glass's resistance to Mariner Eccles' attempt in 1935 to homogenize the Federal Reserve System and bring all of the power within the Board of Governors. The external articulation of alternative views improves public understanding. So no one might have, could be the case that not everyone has the right answer, but it also enhances the incentives of everyone in the group, particularly the chair, to take those alternative views seriously, since they'll be questioned about them more sharply if they're expressed publicly. And I would just note, by way of contrast, other public deliberative bodies in the U.S. federal governmental structure, like the SEC, the FDIC, and the Supreme Court, where dissenting views are publicly aired, they're signed and attributed to members. Dissenting views just get a full airing. In contrast to the FOMC, if you formally dissent, you get one sentence in the statement about the reason, and you get one paragraph in the minutes. That's all you get. Otherwise, the minutes do not attribute any of the views expressed and recorded to any particular member. Other central banks have regimes in which individual members' views are in the minutes and are fully understood and transparent that way. So, bottom line, in its upcoming strategic review, I would strongly urge the Fed, particularly the chair, to reflect seriously on their stance regarding the role of the diversity of views within the Federal Open Market Committee. Thank you.
Well, thanks a lot to MI for hosting us today. I always learn so much from colleagues, and I'm really excited that we have Governor Bowman with us. I will say on the record that Jeff Lacker and Charlie Plosser are among my heroes, because they had courage. This is now going back 10 years. That makes us more than 10 years. But the courage to dissent. And I think Charlie Plosser actually has a very compelling Wall Street Journal op-ed. Again, it's about 10 years old now, but really kind of making it a case that's similar, I think, to some of what Jeff described. It takes courage. And I applaud Governor Bowman for the courage that she has shown in being willing to dissent on some of these financial regulatory decisions. What's amazing, just may be hard for you to imagine, is the Federal Reserve had those regulatory responsibilities for decades. There's no record of votes of those regulatory decisions. The record didn't start to be posted on the Fed's website until about 2010, 2011. And so over those last 15 years, more or less, that we have the records, there's less than 5. If I was trying to count it up, you can count it on one hand, the number of Federal Reserve Board members in the last 15 years who have dissented. It's important. It's an important part of our public body's work. It's an important part of the design that Congress put in place. Congress recognized that many of these decisions are difficult, that Congress itself doesn't have the competency to make the decisions, and it's appointed independent agencies that are supposed to be experts to carefully consider those decisions. And so dissent is a critical part of it, absolutely critical part of it. So, so I want to build a little bit on what Jeff said. How can the Federal Reserve's governance and accountability, public accountability, be strengthened? I want to start with three questions here. The answers to these questions might seem obvious to you, like, why am I even bothering to put them up on the screen? They might seem obvious partly because these are questions that are long-standing, that were dealt with long ago in 1913 when the Federal Reserve was established, and again in the mid-1930s when Congress took things up again and the FOMC was formally established. This is long-standing practice, but also I would say broadly consistent. What Jeff described about principles in organizational management, how other central banks work, what the broad long-standing understanding of monetary economists and others. And yet, these are live questions. First, should monetary policy be determined by a central bank located in Washington? And you may know this, the Eldridge bill was the original kind of version of creating a central bank. Actually, that was the idea, just create one central bank like Bank of England at the time, like the Banque de France. Okay, just create a central bank. And Congress ultimately said, no, we're not doing it that way. And again, it came up in the 1930s, revisiting it 20 years later, and they came to the same conclusion. No, it's a Federal Reserve System. Federal Reserve System. There is a Board of Governors in DC with 7 members, but then there's 12 regional Fed banks, okay? And those 19 people get together to jointly make monetary policy decisions. Second, should monetary policy be determined by a single leader or by a committee of individually accountable experts? The answer might seem obvious to you because it's just obvious when you look at the Federal Reserve Act and when you look at the way that Congress created the FOMC. I think it's safe to say that Congress was envisioning the chair to be first among equals, more or less the way we think of the Chief Justice of the Supreme Court. The Chief Justice sometimes is in the minority, right? Sometimes they don't even write the opinion for the decision. Okay, they might have a concurring opinion, but they don't exactly agree with the rationale of the majority. Okay, first among equals. But I think some of what Jeff said, and I'll emphasize it even more, that's not really how it's working now, and there's important reasons why. Third, we have now decades of academic literature and worldwide experience underscoring the importance that the central bank in its monetary policy function should be insulated from political interference, from short-term political pressures. We have the Watergate tapes of conversations of Arthur Burns with President Nixon that are kind of shocking. Like, oh, you know, that can't happen. That's not the right way for policy to work. Okay, so I've written the question down here, but I think all of us would have thought, oh, well, the answer, that's obvious. We already knew that for decades. Okay, so now let's look at some of what's actually going on. By the way, I'll skip this slide briefly, but the slides will be posted. Okay, when Congress created the very first, what we would consider a kind of independent agency, 1887 was the Interstate Commerce Commission. Congress was well aware of all these issues, so they created a commission with multiple independent experts with staggered terms, a fixed period that was longer than the presidential election cycle. They put in requirements that there had to be a partisan balance. And they put a restriction that the President of the United States could not fire people from the commission except for specific reasons, inefficiency, neglect of duty, or malfeasance. Okay, what's later became just summarized as the term for cause. Okay, this is what for cause means, and lawyers all know to go back to 1887 because Congress spelled it out. Okay, I already said this, but the same kind of principles were established when the Federal Reserve was created in 1913 and reinforced in the mid-1930s when the FOMC was created. Okay, staggered terms, 14 years for Federal Reserve Board members who can only be removed by the President for cause. 12 independent Federal Reserve banks around the country with their own boards of directors. As Jeff said, the law states that the Federal Reserve Board in DC is an oversight body. It's supposed to approve the board of directors' choice. That was the word that Congress used, approval. Okay, it didn't say anything about, well, it should be a joint selection process. Okay, it's just the simple word approval. As a cross-check to make sure that some regional Fed didn't appoint, let's say, a revolutionary anarchist or something there's checks and balances. And again, only removable by the Fed board for cause, which is using the same phrase as they use for the Federal Reserve Board members, and again goes back to those specific criteria. So again, the Fed board could remove someone for malfeasance, but it'd be a very high bar. And finally, the FOMC decisions made by majority vote, 7 Fed board members and 5 Fed bank presidents. Okay, I think what Jeff already told you, and so I'll just go through some more elements of it that he didn't cover, is that over these last 10 years, in my view, there's been a very clear diminishing of the independence of the Fed bank presidents. Okay, and part of it is that appointment process Jeff already described. I was there as a special advisor to the board in 2010, 2012, and I'll say that at that time it was still worked in the traditional way that it came to the board at the end. Okay, so that I can state with a pretty much of a fact. So Jeff was speculating that it may have started in 2010. No, I don't think so. Okay, but these are important questions that historians should try to figure out. So we'll leave it there for now. But there are other elements here going on. The Federal Reserve Board controls the budgets of the entire Federal Reserve System. And I think you can see it pretty clearly. What's happened over time is the Federal Reserve Board's been very generous in allowing its own budget to go up, while constraining the budgets of the regional Feds. And that's literally happening to this day. Okay, so on monetary policy, the Federal Reserve Board now has more than 700 staff in the 3 departments, international, research, statistics, monetary affairs. Those are the 3 departments that are really responsible for providing the background to the Fed chair and to the committee. 700. And each individual regional Fed bank, I just checked this on the web last night to make sure, it has about 10 to 12. Okay, so they're grossly outnumbered. And even if you put them all together, and of course you shouldn't because each regional Fed president is supposed to be independent, okay, they just have a tiny staff to help them. And I was shocked to learn a few months ago that there's currently a hiring freeze on the economists being hired at regional Feds this year. And I was just like, why is that? Right, if anything, given what's happened over the last few years, there would be a recognition that there needs to be even more hiring and more talented people with diverse backgrounds and perspectives. Threat of removal is salient. And I'll just say that at the time that President Trump was trying to figure out if he could fire Chair Powell, and it turned out the attorneys all said, no, you can't do that. Okay, you might disagree with his decisions, but it's not malfeasance. It's not neglect of duty. Okay, it's a matter of judgment. But at that time, the White House did a broader review of the Federal Reserve's governance structure, and it's an important memo, legal memo, official ruling, where part of what they looked at was how the FOMC worked. And they concluded that the Federal Reserve Bank presidents are subordinates of the Board of Governors. I should just go, that's actually on the next slide, sorry. Okay, since that ruling was made, I shouldn't say ruling, that's like a court, that legal opinion was issued by the White House Legal Counsel. No, to my knowledge, no Fed officials ever commented on it, no Fed officials ever contradicted it. In principle, a member of Congress could ask Chair Powell, and Chair Powell, would hopefully respond to sort of say, yes, that's how we see it now, that they are our subordinates, or no, that's absolutely not the case. But this opinion seems contradictory to the original design of the FOMC. So I would hope that actually the Fed itself could publicly state, no, that's not how we're trying to work. But it looks like that because of all these reasons with the budget. I wanted to say a comment here about the New York Fed president. You go back and look in the history from 1951 until 1978, and there was a sequence of 3 or 4 presidents of New York Fed, and each of them dissented multiple times. Paul Volcker was the latest president of the New York Fed before he became, renowned Fed chair. Okay, you can look in the late 1970s, he was multiple times dissenting. But starting in the 80s, into the 90s, and now the last several decades, the New York Fed president is now viewed as a key ally of the Fed chair. They never dissent. They're very directly involved in the formulation of the monetary policy, okay, but they're not an independent voice anymore. I think it's safe to say. And so the extent to which Jeff said, well, the only person who is been appointed as a monetary economist, I think is the way you described it, in the last 10 years is the president of the New York Fed seems unfortunate because maybe that person would have actually had a stronger independent voice if they continued at a different Federal Reserve Bank and not at the New York Fed. Okay, so the consequences, still skipping here, sorry. I just want to say there's institutional culture here too. The institutional culture that I've been told by multiple people is I'll call it an electric fence. And you're either on one side of it or the other. And if you are on the side of supporting the Fed's, the decisions, voting in favor of those decisions, and speaking broadly in favor of them in your public remarks, then you're on the good team. And if you want, you can go over to the other, you could go over to the other side, but you're gonna be ostracized, you're gonna be shut out, you're not gonna be part of the decision-making process anymore. And that kind of culture has developed slowly over many, many years. But I think that's part of the difficulty here. And so the change you're suggesting, Jeff, about kind of getting them to rethink this probably does have to come from the Fed chair. And maybe it won't come from this Fed chair. Chair Powell has 2 more years. Maybe Congress needs to ask nominees in its advise and consent role to be, for the next, who will be the next chair, what their approach is going to be. Are they going to treat the Fed Bank presidents as subordinates? Are they going to give them freedom and encourage them to express diverse views as Chairman Bernanke did? Okay, this picture you already saw. Now I want to talk for a couple minutes about the Federal Reserve Board. Sorry, I'll wrap up in 2 minutes here, I think. The Federal Reserve Board has some legal challenges that have reinforced the Fed chair's really dominant role in monetary policy decisions. Okay, so we know, of course, Fed chair, that's the person who sets the agenda for the meetings. But sometimes setting an agenda sounds kind of innocuous. In this case, setting the agenda means determining the monetary policy options that the committee will discuss at the meeting. They're usually labeled A, B, and C, and going back 50 years, everyone knows alternative B is the chair's preference. And you can look at many meetings where they take the vote, going back to the 60s and 70s, and the answers are, yes, Mr. Chairman, I support alternative B. Right, that's, everyone knows, okay, yeah, that's a vote in favor of the decision. So being Fed chair is really important, but also the Fed chair is CEO of the Federal Reserve Board. Under the Federal Reserve Act, it's called active executive officer. The other members of the board are non-executive directors. The chair is the CEO. Now, when that was put in the 1930s, it was innocuous because the Federal Reserve Board only had 250 staff and only about 20 to 25 who were working on these kind of macroeconomic monetary issues. So, oh, well, who cares who's officially the CEO? It'll all work out. But now that there's 700 plus staff working on the monetary and macro issues and supporting the committee's analysis and providing forecasts that are really the center point for the FOMC's projections. Now you say, oh, well, gosh, I mean, being CEO, that's a pretty big deal now. That's a really critical element of the process, of the governance process. So Jeff said, well, gosh, it seems like it's becoming a corporate board. And I would say yes, in the sense that it's like a corporate board where the CEO is also chair of the board. And this just come up in the news yesterday and today about a major financial institution where some major shareholders are questioning that. The United States has been exceptional in having some major corporations where the chair is also CEO. But do we want that for a key public institution like the Federal Reserve? I think it should be rethought. And so the consequences here, I'm going to have to skip forward here, is because the Fed chair plays such a central role, in the last couple decades, other board members don't tend to stay very long. The ones I've spoken with, the ones I've interacted with, during the 20 years I was there, and sometimes since then, they feel kind of marginal, like, oh, it doesn't really matter whether I'm there or not. And they go on to other things. And so that further strengthens the equilibrium where the Fed chair plays a really dominant role. Again, congratulations to Governor Bowman, because you've stuck out now, for since 2018, I think, right? It's one of the, you're at the top end of this this spectrum here. No dissents. I think Jeff mentioned this, but now you can kind of understand why there hasn't been any dissents for 20 years on the monetary policy issues, and swings in the political affiliations. Because if almost all the board members are only staying for a few years, then we have a situation where in 2018, almost everyone on the Fed board had been appointed by President Trump, even though he'd only been in office for 2 years. And now we're in a situation where 5 out of the 7 members of the Fed board have been appointed by President Biden, even though we're just 3 years into his term. Okay, so final slide. What can we do? I think there's an important role here to have a fully independent IG, Inspector General, because that IG, if they could look at the whole Federal Reserve System, could be looking at the appointment process and making recommendations about how to improve it. They would have to be fully independent in order for that to be credible. The GAO should have comprehensive reviews of the Fed and everything it does, including the decision-making process and the appointment process and so on. But also, I think it's time, probably high time now, it's been 40 years since the last one, that Congress should appoint a new monetary commission. Okay, and have that independent commission take a look at the Fed's governance and transparency and accountability. So I'll stop there. Thank you very much. Oh, you want to stand up here? And okay, that's a good idea.
Well, we've covered just an extraordinary array of issues. And once again, I want to thank the Manhattan Institute for giving us this opportunity to discuss these issues. We do have time for Q&A, and I presume that those comments by our speakers should elicit some questions. Yes, Phil.
Thank you. Instead of addressing the really important diversity discussion of views, I wanted to point out the beginning of the discussion where there was a discussion about how we should perhaps start thinking about focusing on nominal GDP vis-a-vis all the other versions. So as I understand it, back at the end of COVID, or the beginning of COVID, this notion, which is a dirty word that everybody don't want to use, is this temporary aspect of inflation. There is some credibility to that temporary aspect. And that my understanding originally is the Fed really didn't want to jump the gun. The policy idea was to wait until we see the white of the eye of inflation before we react. So we can say that it's really backward looking, because by the time you see the white of the eye, it's already kind of too late. But my understanding always been, and I'm probably dead wrong, but that Fed has always been a little slow in taking any action. So we're slow in coming in, we expect them to be slow to be getting out. Is that a framework that you fundamentally disagree with? Because I think Athanasios talking about really be more sensitive as we look at your situation where, oh boy, we see the curve going up, it doesn't take a genius, it's going a certain direction, let's raise rates. But part of that discussion also is how sensitive, how do we calibrate? Is the central bank supposed to be that sensitive? May be correct, but what kind of impact would that sensitivity be to the general economy as well? So I'd love to hear that, sort of diving in a little bit more about, is that right? And I also think the Fed gives itself way too much credit, thinking that raising rates have done all that extraordinarily about reducing inflation. I think they're taking way too much credit previously, and I think they're going to take too much credit later. Because I do not believe that's the case. So thank you very much. Apologize.
No,
you want us to
Sure.
answer?
Athanasios.
Okay, sure. So thanks for the question. So I'm going to start answering this by reminding you of what Marvin Goodfriend kept telling us at our earlier meetings about the 70s. So the 70s was a period when the Fed was engaging in stop-go cycles, and Jeff, you would remember this as well, which was explicitly being always too late, just looking at the data and being too late to respond. But historically, in its history, the Fed, recognizing the lags in the monetary policy transmission, has tried to be forward-looking. Now, explicitly, in recent history, the Fed started saying explicitly that it was preemptive, starting with the 1994 increase in interest rates, and that was about the time when they switched to the interest rate policy instrument. But as a matter of fact, even earlier, if you go back to the 1950s, even as early as the 1923 hike, the Fed was explicitly explaining that it was being preemptive. And I would suggest that the periods when Fed policy has been more effective are those periods where the Fed has tried to be preemptive, the Fed has tried to be forward-looking, even taking into account that means from time to time you will be wrong because your forecasts are going to be wrong. There's nothing wrong with that. You're trading off the two sides. With respect to the pandemic, in my view, the Fed made a strategic mistake of actually switching its strategy to be explicitly myopic. You can see that clearly in the September 2020 FOMC decision and the forward guidance that was provided then, which was totally incompatible with what the Fed had been doing the previous 30 years. But I will also say that you're right. Not all of the inflation was created by the Fed or killed by the Fed later on. There was a transient component to inflation that component would have dissipated even if the Fed didn't do anything. But the Fed ended up providing excessive accommodation that actually did create additional persistent inflation, and this is what they have been trying to fight over the past couple of years. I have to end by saying that I agree with Peter that at the end of the day, if I look at where the Fed has been the last 6 months, it's fine. It's not much out of line with the reasonable frameworks. You know, we can quibble with that, but it's fine. It was just massively off in coming out of the pandemic in every quarter in 2021, several percentage points off in terms of policy calibration.
Yeah, I would only add just 3 very quick points. Yes, to me, it seems like the big lesson learned from the great inflation followed by the great moderation is that monetary policy works much better if it acts preemptively, raising rates before inflation goes up, instead of, as the revised 2020 statement suggested, waiting until you actually see the inflation. That was a mistake made many times before, and I see the experience of 2021 is just a reminder of how important that lesson is. Now, just to tie it back to nominal income targeting, I don't think that observation is necessarily inconsistent with a policymaking framework that's built intellectually on the Phillips curve foundation. The 2012 policy statement, which I view as really quite good, I think did a nice job of finessing that by saying, our job in the long run is to provide a framework for nominal price stability. There is the employment mandate. There was the talk about the balanced approach. Ordinarily, there's no inconsistency between the two sides of the dual mandate. However, what I would say is an empirical matter. I think Phillips curve reasoning lends itself to a slide back into the kind of stop-go monetary policy making that plagued us during the 1970s, because it encourages a kind of lexicographic style of thinking where one year you're worried about unemployment, the next year you're worried about inflation, you're always behind the curve, you're always doing too much. So what I find to be the great appeal of nominal GDP targeting is that it just rolls it all up into one sufficient statistic that's a nominal variable And I think that can help guard against that sort of.
Greg. I'll speak very quick. In a statistical sense, inflation is one of the stickiest, most persistent, economic processes that we have in U.S. economic data. To place all the weight on temporary when you're in the face of one of the most persistent economic processes seemed rather unwise. You'll notice now that before there was a great chorus about temporary and transitory, and if you listen now, it's all about, everything's so persistent, right? Inflation's not persistent. Trust me, inflation is always persistent.
Thank you very much. As a practitioner of the corporate governance, and I advise the large financial institutions from the board governance point of view, I agree with Governor Jeffrey and Andrew Levin on one of the suggestions you made was on the last slide, especially having a watchdog and also the monitor the commission, which an oversight. In my view, or you can correct me if I'm wrong, if you have 12 regional governors and you have a number of Federal Reserve Board of Governors, do you think having more oversight hampers the decision-making process, or how you expect the communications to go out to the public when they're expecting to have any monetary policy decisions?
Andy?
Oh, yeah, just to be clear, so none of these GAO, IG, Monetary Commission, they all are advisory, if I could put it that way, right? The GAO looks at what NASA's doing, and it writes a report, and that report's published, and Congress can have a hearing if it wants, or the report can just get filed away in a desk drawer. The Inspector General, I think, already has responsibility at the Federal Reserve Board, but the IG does not have any authority to do anything with the regional Federal Reserves. Okay, that would be a simple change for Congress to make, just a Federal Reserve System IG instead of a Federal Reserve Board IG. Okay, and then it's just a cross-check, and sometimes when everyone knows there's a cross-check, it makes people a little bit more careful. The same question came up with the first panel with Charlie and Debbie, right? That when there's transparency, that creates more accountability, and I think the same would be true here. That a big reason for having the IG and the GAO or involved. The Monetary Commission, I think, is to revisit some of these questions. For example, if you wanted the role of Fed chair, to be separated from the CEO, I think that should be considered. But Congress can't decide that and just put out a bill. There should be a Monetary Commission that would say, well, how would that work, and what can we learn from other central banks, and what can we learn from history, and it would be done carefully with historians. By the way, Mike Borda's not involved today, right? But he was involved with the Gold Commission 40 years ago. He was assisting Anna Schwartz when she was on that commission. Okay, it'd be so wonderful if Mike Bordo could be on the new Monetary Commission now with all of those decades of experience that he would bring to this.
Great presentations all. Athanasios and Peter, just as a side note, the Phillips curve correlation is literally 0 since Mr. Phillips' paper, as you may know. And I think what you propose is a significant improvement, but I wonder in the current environment, yes, Paul Volcker controlled inflation, but there's not a track record of the Fed actually being able to hit its target for a good long time from each direction now. If for a decade or more, they couldn't reach 2%, and now it certainly appears as if inflation may be bottoming out, so they can't get down to 2%. So what confidence can we have that they can actually hit the targets, even if they're more carefully constructed, as you've proposed?
Well, I'm not sure I would agree with the characterization that the Fed hasn't done a good job of guiding inflation to be around 2%. If I look at the last 30 years, with the exception of the post-pandemic inflation surge, I think the Fed did a reasonable job I don't think we should be. Let's wait for 5 seconds for this.
Oh, another earthquake.
Yeah, it's a new one. It's aftershocks. So if we were in Tokyo, or in other places, we would need to worry much more about this than in New York, based on the history. So I was going to say that. The Fed did a fairly good job of keeping inflation within a range of 2%. That was reasonable. I don't think we should be in favor of fine-tuning anything specific. We all know that. Take whatever your favorite price index is, you cannot fine-tune it exactly. If I evaluate policy in terms of our inflation expectations a couple of years out, that the public, that markets have, are the Fed's own inflation projections in line with the 2% objective, I think the Fed was actually doing a pretty good job overall. I would be very happy if the Fed delivers price stability in the next 30 years, the way they deliver price stability from the mid-90s to 2020.
Jeff? Yeah, the Fed never, when it adopted the framework, the one in 2012, never said how close was close enough to 2%. Leading up to that, there'd been a decade of discussion within the committee of adopting an inflation target. The discussion was always a range. And then all of a sudden, in the last year, it became a point forecast. Inflation was running below 2. It seems, in hindsight, as if the point target was adopted because that would be sort of a more dovish framework to adopt. And then over the course of the next decade, some people wound themselves into a knot over a miss of 0.3%. And adopted, and that was the rationale for the change in the framework in 2020 and the forward guidance in September, which, as Athanasios explained, throughout the mainstay of the success of the inflation, of the price stability period that began in the mid-90s, the preemptive policy. So I think in this framework review, I think they'd be well advised to answer that question, maybe consider a range. Maybe it doesn't have to be 1 to 3. Maybe it could be 1.5 to 2.5. But even if they don't, on the way down to 2%, they're going to face this challenge. If 1.7 wasn't close enough, they better not stand pat on 2.25. I mean, they better not declare victory at 2.3 or 2.2 or so, and be able to save face.
Bob.
Thank you. And I want to thank everybody for these presentations. It's been really great. But I do want to go back to this point and hammer at it a little bit more, because I take some exception to what Jeff just said, even knowing that you're powerful enough to start earthquakes. That, to me, the issue is not whether the Fed was hitting its target. It's that during that period, after the Fed started to raise rates, when, again, every single FOMC member in 2015 had at one point said that the Fed would start to raise rates. Let's remember that right now, Mr. Powell is saying the exact same thing about cutting rates this year. And so they wound up raising rates in 2015. If I remember, Stanley Fischer was warning the markets about how aggressively they were going to raise rates over the next year. And they barely managed to get one rate hike in by the end of 2016, right? So the Fed had that one wrong. But once they did start raising rates, the thing that was interesting to me is that this was also the time that the Federal Reserve engaged in this policy called no regrets, where they weren't looking at incoming data, they were running policy off their forecasts, and where inflation was consistently coming in below their target. And maybe by just a small amount, maybe it really was a hit, but they continued to raise rates. The Fed raised rates, undershot its target, raised rates again, undershot its target. So somebody back there said, oh, the Fed was unable to hit its target. Well, that's not true. The Fed never tried to hit its target. That whole period, from 2015 up to 2018, the Fed basically was undershooting its target, very close, but undershooting and raising rates. Why was it raising rates when it was persistently undershooting its target? The Fed obviously had another agenda at that point. And the agenda very clearly, to me at least, was that we've been through this period of zero rates. They wanted to get up to something more normal, and they were making that the priority. So to me, this is an issue of communication. The Fed wasn't telling us what its real policy was. And so we have a problem here of communication. We have a problem of manipulation. We have the Fed telling us things that it's not doing and making them policy. I found this a very confusing period, and it looks to me like we're doing it again. So I'm wondering if anybody has comments on that. Thank you.
Okay. Quick responses.
So let me address this by also responding a little bit to what Jeff said. So I'm in favor of actually having a precise number for the definition of price stability. That actually helps with accountability. But then I would want to communicate more clearly along the lines of your question that you can never expect the central bank to precisely hit that number. You need to recognize the uncertainty with which you will be hitting that number, and you need to communicate well how much uncertainty you expect to have in the data. And on this, in past meetings, I remember Mickey Levy has worked on. You have to be communicating uncertainty associated with projections that the Fed is doing better. Yeah, the Fed now put in the bag of the SEP some charts with historical fund charts of uncertainty that I don't think anybody pays attention to. I don't think the uncertainty associated with short and medium term projections has been communicated clearly. If it had been, people would actually recognize that being 0.2% above or below your target is not a big deal. And policy is still good policy if you explain that even though I am a little bit above or below, I'm getting there, and I'm actually acting in a systematic fashion to get there. So by not communicating uncertainty, they also create these question marks about, are you trying to hit the target or not? In my view, the Fed was trying to be true to the 2% reasonably from 2012 to 2019. We can quibble a little bit about the policies, but overall, I think that was a pretty good period.
But before we get to the next question, Bob, I think that period, 2015 to 2018, I think a lot of the Fed's communications and research were influenced by its asymmetric view of inflation around 2% and its extreme concern about, a sharp decline in inflationary expectations and the effect of zero bound. And that just became more and more evident in all the research that almost predetermined their new strategic plan. Anne-Marie?
So, Mickey?
Yes, Charlie.
Mickey, oh, sorry. I'd like to say what a great panel this has been. I've enjoyed every speaker, agree with very much of what's been said. I want to elaborate on one point, though, that Jeff alluded to. This business of consensus voting by the committee and the importance. Jeff talks a lot about that. One of the pushbacks you often hear by the board or the chair at times is, well, the committee has to band together and be united in order to have the important impacts that it needs to have. And so we have to build a consensus that we all can get behind. So I want to make two references, two observations about that. One, I think that's dangerous for two reasons. One is that it's not transparent. It actually hides diversity of opinion within the committee, and it ends up leading the committee to write policy statements that are vacuous, that have no meaning, or they can't be interpreted because they're trying to write a statement that will allow everybody to vote for it. And sometimes that's not possible, and that inhibits communication and accuracy of the debates. And what's really true is that by being more open and more open to dissents and disagreements publicly, the public actually ends up learning more about what the Fed is facing and the choices it's facing and how they feel about it. so that they don't get surprised later on when there is in fact a policy change. So it's really important about communication. Related to that, and I'll stop after this, is that we have evidence about how this works in many respects. The Bank of England, when the Bank of England established its independence back in 1998, there was a huge debate about exactly this point. People were worried that, well, the markets will not appreciate all the uncertainty and debates, that you need to act with one voice, and yada, yada, yada. But what the Bank of England did, and what the government did, is say, we're going to appoint Monetary Policy Committee members, MPC members, and they have the obligation to express their views, to express their opinions, and to vote accordingly, and be able to answer to the public and to the government why they voted the way they did. That was a requirement, or is a requirement, of being on the Monetary Policy Committee in that system. So it was required that they would vote their views, not that they would succumb to consensus policymaking. And there was great concern that that was going to be a communication disaster, but it wasn't. Not only that, what we know from experience is that when Mervyn King was governor, I don't know what the dates were, 2003 to 2013, something like that. Mervyn King did more to establish the independence of the Bank of England than anyone ever did. Mervyn King actually was outvoted several times during that period, was not on the winning side of votes. And I would say there's a great value to the institution. And I wrote about this a little bit in this editorial that Andy spoke about earlier. There was great value to the Bank of England in establishing the independence and strength of the institution rather than just the person that happens to be the chair. And Mervyn did more to support that independence and the credibility of the institution than anyone did, because of his willingness, I think, in part because of his willingness to be on the losing side of a vote every once in a while. That's the strength, that's what makes the institution strong, not one that praises the individual who happens to be head of that committee on that particular day or in that particular era. So I think this is really important about establishing institutional credibility. So thank you for the opportunity to say that.
Thanks, Charlie. Anne Marie. And then make it quick because we're running against a time constraint.
Yeah, making it quick is tough, and an awful lot of threads have been thrown around, but I want to maybe tie together something from Charlie's presentation and this panel's presentation about the motivations of the people who are making these decisions. And I think they need to be worked more into the monetary policy side of the Federal Reserve, as well as the regulatory side of the Federal Reserve. But what I'd had in mind to ask is about the attitude of the non-economist public versus the attitude of almost all of the economists probably in this room and listening from elsewhere, that a little inflation is good, a lot of inflation is terrible. And I think that, and that deflation is terrible. And I think that we need to sort of go back to first principles to look at that, because one thing I've noticed in talking with non-economist friends is when they define getting rid of the current inflation, they want to go back to the price level of 2019, more or less. That's right. And so I think the economists need to think about who is being hurt and who is being helped much more deeply than they have been for a long time from this sort of upward creep of inflation at various rates over the last couple hundred years. And because retired people, for the most part, are being more hurt by inflation than somebody who's working at a financial market trading firm or whatever.
So I'm going to cut you off.
Okay.
I'm gonna cut you
So
off.
that I want to throw out for future
Responses?
thinking.
No, I think that's an excellent point. I also think that it's a valuable point for Fed officials to keep in mind. Even if things go great and we get back down to 2%, say, in 2025 without a recession, I think FOMC members need to avoid the appearance of celebrating that fact too much, because it's going to create a disconnect with the public that says, well, wait, but the damage is still there. Yeah.
Okay. A quick note.
Yeah. So Mike
Wait.
Yeah. When my recollection of the speeches was Mishkin and Bernanke mainly were making this asymmetric discussion. Mike Bordo for the committee did a paper, historical review, showing that it wasn't true. So we have actually addressed this question. I think the point of his paper, which I would second, was that it was unanticipated large inflation was really a big deal, not whether it was deflation or inflation.
Okay, so with that, we're going to have to conclude this panel. Instructions. Grab your quick lunch. Don't huddle in the back so you can let other people come in. Governor Bowman is going to begin her speech at 12:15, which gives us a very tight framework. Thank you very much. Grab your lunch. Great panel. Spectacular.
It's a rules-based committee. So in some respects, we can actually hit the target. We don't need to be 0.2 above or below. Now, of course, it's always risky when you have a Mediterranean keeping time, but I appreciate your trust in this, but let's go on with the program. So we are honored today to have Michele Bowman with us from the Board of Governors. Now, Michele Bowman has been serving as a member of the Board of Governors at the Federal Reserve System since late 2018. And one of the things that we will be watching with the discussion we had in the previous panel about the short tenure of various members is that so Michele Bowman may prove us wrong. Initially, she was appointed to fill the remainder of an incomplete term, but then in January of 2020, she was reappointed. And in principle, we could have you with us until sometime before 2034, when is the end of the full term. So we're going to be watching this to see if this actually changes the statistics that were presented earlier today. Now, on the board, Michele is one of the experts on the banking side, and this reflects very much her background. Prior to her board appointment, Bowman served as the Kansas State Commissioner, and before that, she actually held high-level positions in a community bank in Kansas. And this is one of the things that actually work well in the system, as we've shared before. The Federal Reserve System was set up as a system in 1913 because twice before, when there was an attempt to send a central bank in the United States, that central bank only lasted 20 years. So it was quite deliberate to have a system with diverse views, with diverse representation. And even though we're in New York City, part of the debate was how do we defend the rest of the country from what is happening in New York? How do we protect what is happening with community banking and so forth? Now, with all of that said, Michele Bowman gave a couple of speeches earlier this week where she talked about banking and liquidity issues. And at this event, she wanted to honor us by talking about monetary policy. So we're going to have a discussion on monetary policy. The talk will be on risks and uncertainty in monetary policy. And after the initial remarks, we're going to have a brief conversation. And thank you very much for letting us have a Q&A and an open discussion. The floor is yours.
Great. Thank you, Athanasios. Thank you so much. Well, it's really a pleasure to be here with you, even on a day where we're having some earthquakes or some emergencies. But I won't follow Jeff and have ground-shattering things to say, I don't think. But you can tell me if I do later. But thank you so much for the opportunity and the invitation to come and speak at the Shadow Open Market Committee. The SOMC has a very distinguished reputation for fostering substantive analysis and debate regarding independent, transparent, and systematic approaches to central bank policymaking. It's really a pleasure to join you today to discuss some of the current issues that are facing central banks and monetary policymakers. So in my remarks today, I will review some of the notable developments in the US economy and in the financial system, as well as review key monetary policy decisions and communications since I joined the Board of Governors of the Federal Reserve System and became a permanent voting member of the FOMC in late November of 2018. As I look back over these 5+ years, I will consider how a range of uncertainties and risks regarding the macro economy and its measurement have affected monetary policy decisions and communications. I'll also highlight some considerations regarding financial stability risks and monetary policy. I'll conclude with my own views on the near-term economic outlook, some of the prominent risks and uncertainties surrounding my outlook, and my views on their implications for monetary policy going forward. So I'll start with setting monetary policy amid a wide range of uncertainties and risks. An ever-present challenge monetary policymakers face is how to account for uncertainties surrounding the current state of the economy and the economic outlook when we're setting monetary policy. Macroeconomic models that can help guide the setting of monetary policy often invoke unobservable concepts such as the natural rate of unemployment, potential output, or the neutral real interest rate. These unobservable concepts can be estimated, but only with a considerable degree of uncertainty. And those estimates may vary over time, for example, because of structural changes in the economy. Macroeconomic models are also subject to uncertainty, since they must make simplifying assumptions regarding the complex set of relationships and interactions between households, businesses, governments, and the financial system that also evolve and change. Moreover, the data that are used to estimate model parameters and to formulate the economic outlook are inherently uncertain, and they're often revised as statistical agencies refine their estimates or as they gather more information. In addition to uncertainties surrounding macroeconomic models and measurement, there are a number of risks that, if realized, could shock the economy and the financial system, making it even more difficult for policymakers to confidently assess the economy and the economic outlook. But despite these challenges, monetary policymaking requires a forward-looking approach, as was discussed earlier, since its actions affect the economy, labor markets, and inflation with a lag. So I'll talk now about the post-financial crisis economy and monetary policy at the zero lower bound. When I joined the FOMC in late 2018, despite nearly a decade of accommodative monetary policy following the financial crisis and the subsequent recession, one of the primary concerns was that inflation had persistently been running slightly below the committee's 2% inflation target. There was a recognition that the natural rate of unemployment may have been lower than many on the FOMC had estimated, and that inflation may have become less responsive to reductions in the unemployment rate. This recognition meant that preemptive increases in the federal funds rate based on expected reductions in the unemployment rate alone may not have been needed to keep inflation and inflation expectations aligned with the committee's 2% target. A central topic of FOMC meeting discussions throughout 2019 was how monetary policy strategies and tools could best achieve the committee's dual mandate of price stability and maximum employment when structurally low interest rates and disinflationary forces kept inflation persistently below the committee's inflation target. There was also a concern that the federal funds rate, the FOMC's key policy rate, was too close to the zero lower bound, and that this proximity could limit the committee's ability to respond effectively to an adverse shock by using our primary monetary policy tool of lowering the target range for the federal funds rate. More broadly, many central banks around the world were grappling with the prospect of structurally lower interest rates due to a variety of factors, including demographic changes and higher savings rates, lower potential output and productivity growth, and greater investor demand for safe assets like Treasury securities. At the time, the FOMC assessed that downward risks to both employment and inflation were likely to remain prominent due to the proximity of interest rates to the zero lower bound. In August of 2020, the FOMC significantly revised its statement on longer run goals and monetary policy strategy to reflect this assessment. One notable change relative to the initial statement adopted in 2012 was a change in the language addressing how the FOMC would conduct monetary policy. The new statement noted that the committee would seek to mitigate shortfalls rather than deviations of employment from the committee's assessment of its maximum level and deviations of inflation from its longer run goal. By replacing the word deviations with shortfalls when describing employment, the committee's reaction to changes in employment relative to estimates of its maximum level, the committee indicated that it would not act preemptively to curb inflation based only on the perception of labor market tightness. Another notable change to the strategy statement was the adoption of what some refer to as asymmetric flexible average inflation targeting, or temporary price level targeting. Specifically, the new statement noted that in order to anchor longer-term inflation expectations at its 2% goal, the committee seeks to achieve inflation that averages 2% over time, and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. The revisions to the FOMC statement focused on monetary policy in a world of structurally low interest rates, disinflationary forces, and an apparent insensitivity of inflation to low levels of unemployment. Although the revised statement reaffirmed the commitment to the committee's inflation target, it did not describe how the committee would respond if inflation were to run persistently above its 2% goal. Given the timing of its implementation, the revised strategy guided how the FOMC responded to one of the largest shocks experienced by the US economy in recent years, which was the COVID-19 pandemic. This shock, combined with the policy responses of governments and central banks around the world, disrupted many of the dynamics that had influenced the economy over the previous several decades and the post-2008 financial crisis approach to monetary policy. These impacts will affect how we think about monetary policy going forward. But let's first put the COVID event and our response into better context. So I'll turn now to the COVID shock in monetary policy and our response. Toward the latter part of the FOMC's monetary policy framework review, in March 2020, the pandemic created an unprecedented shock to the global economy and the financial system. Widespread economic lockdowns and social distancing, combined with other pandemic effects, caused the swiftest and deepest contraction in employment and economic activity since the Great Depression. Many critical parts of the US financial system experienced significant disruption, or they completely ceased to function. The Federal Reserve responded forcefully to mitigate the financial market turmoil and the economic effects of the rapid shutdown of the US economy. And I'll have more to say on that topic later. But as a part of its response, the FOMC quickly lowered the target range for the federal funds rate back to 0 to 0.25%, and we began purchasing large amounts of Treasury and agency mortgage-backed securities. These purchases were initially designed to support the smooth functioning of securities markets and the flow of credit to businesses and households. Later, the purchases provided additional monetary policy accommodation to support economic activity and labor markets. Following the return to the zero lower bound, in addition to conducting asset purchases, the FOMC used forward guidance to provide additional monetary policy accommodation to keep both short and longer-term interest rates low. In its March 15, 2020 statement, the FOMC noted that it expected to maintain the target range for the federal funds rate at 0 to 0.25% until it was confident that the economy had weathered recent events and was on track to achieve its maximum employment and price stability goals. Following the release of the revised framework in August 2020, the FOMC revised the forward guidance in its September post-meeting statement to be more explicitly outcome-based and state that the target range would remain at 0 to 0.25% until labor market conditions have reached levels consistent with the committee's assessment of maximum employment. And inflation had risen to 2% and is on track to moderately exceed 2% for some time. In its December 2020 post-meeting statement, the FOMC added forward guidance regarding its asset purchases by noting that it expected that the current pace of asset purchases would continue until substantial further progress has been made toward the committee's maximum employment and price stability goals. This explicit outcome-based forward guidance, like the revised monetary policy framework, was very focused on supporting the economy during the COVID shock amid the risks of persistently low inflation and disinflationary forces with structurally low interest rates. The guidance was also quite restrictive in the criteria for slowing the pace of asset purchases, especially since the FOMC would stop asset purchases before it would raise the federal funds rate. One could argue the December forward guidance made it much more difficult for the FOMC to react to new information, suggesting that risks and uncertainties had evolved in response to the pandemic-related changes in the economy. Other uncertainties, such as the accuracy of real-time economic measurements, also presented challenges, as did significant supply-side disruptions and the uncertainty about the timing of progress toward their resolution, which I'll discuss next. So turning to the post-pandemic economy, the resurgence of inflation, and the rapid tightening of monetary policy. In the early phases of the pandemic, fiscal authorities around the world implemented support programs for labor markets and households and businesses. These generous policies, combined with very accommodative monetary policies, bolstered private sector and state and local government balance sheets. In particular, they led to what has become known to as excess savings, which are above normal household savings from extraordinary levels of fiscal support and a limited ability to freely spend it due to economic lockdowns, supply chain disruptions, and other pandemic and recession-related factors. In 2021, novel medical treatments, reduced social distancing, and innovative business approaches in adapting to the restrictive pandemic environment led to a sharp rebound. Strong demand, supported by stimulative fiscal and monetary policies, a reduced labor supply due in part to early retirements, childcare responsibilities, concerns about COVID, and a mismatch between available jobs and workers, all contributed to a very tight labor market. The unusually rapid rebound in economic activity, pandemic-driven shift to consumer goods spending, supply chain fragilities, and manufacturing component shortages led to crippling bottlenecks for a number of industries. These supply and demand imbalances, likely amplified by fiscal and monetary policies, led to a sharp rise in inflation over a period of just a few months. By the second half of 2021, inflationary pressures intensified and became more broad-based. Labor markets were extremely tight, though it was difficult to assess the true extent of the tightness given the decrease in labor force participation and the mixed data signals that we were getting at the time, which were all later revised. Of the many difficult issues the committee faced, one of the most important was whether inflation would persist or would resolve as supply-side issues eventually eased. The September 21 SEP showed the median FOMC expectation for PCE inflation of 4.2% at the end of 21, largely reflecting high inflation readings from the first half of the year. But for year-end 2022, the median expectation was for PCE inflation to decline to 2.2%. Private sector forecasters expected higher inflation of 5.1% at year-end 21, but also projected a slowing to just over 2% by the end of 22. With the benefit of hindsight, we now know that most forecasters, ourselves included, vastly misjudged the persistence of inflation at that time, with 5.9% PCE inflation for both 21 and 22. This example underscores the challenge that we face in identifying which factors were driving inflation and how long those forces would persist. In the second half of 21, it became clear that the FOMC's monetary policy stance was too accommodative in the presence of growing inflationary pressures, and that the committee needed to move toward a tighter policy stance. It seems likely to me that the experience of the years leading up to the pandemic, when inflation was persistently low, made it hard for many to foresee how quickly that situation could change. Of course, the inflation and labor data did not accurately reflect the economic conditions that were prevailing at the time, and they were subsequently substantially revised. Together, these factors, combined with the FOMC's forward guidance discussed earlier, contributed to a delay in the removal of monetary policy accommodation in 21. The shift in the committee's forward guidance toward the end of 21 and into early 22 was effective in moving longer-dated interest rates higher and in tightening financial conditions, even before the FOMC raised the federal funds rate. At our November 21 meeting, we announced that we would begin to slow the pace of purchases later that month. At the December 21 meeting, we doubled the pace of tapering, which accelerated the end of purchases to the following March. At the March 22 meeting, the FOMC raised the target range for the federal funds rate by 25 basis points. And in May, the FOMC announced its plan to reduce the size of the Federal Reserve's securities holdings, which then stood at around $8.5 trillion. Starting in June and at a pace much faster than in the previous episode of balance sheet reduction. The FOMC also continued to increase the target range for the federal funds rate over the course of 22 at a pace much faster than in previous tightening cycles, as it became very clear that inflation was higher and more persistent than many forecasters had expected. By July of 23, the FOMC had increased the federal funds rate to 5.25 percentage points and into restrictive territory, where it has remained. And we've continued to reduce the size of our securities holdings. The monetary policy experience during the pandemic highlights how difficult it can be to assess the current state of the economy and to predict how it will evolve in the presence of major supply and demand side shocks, possible structural changes in the economy, and real-time data measurement uncertainty. An important question that I will be thinking about going forward is how to make monetary policy decisions and communications more robust to these types of risk. So now I want to turn to separating the tools from monetary policy and financial stability, as again, you all set the stage nicely earlier in both of the panels. But we know that monetary policy transmission is most effective during periods of stable financial conditions, and that financial stability risks, if realized, can affect the economic outlook. While monetary policy and financial stability are connected, financial stability vulnerabilities and risks are most appropriately addressed using macro and micro prudential regulation and bank supervision. During periods of extreme financial stress, well-calibrated lending and liquidity programs can be used to address such conditions. Of course, where risks impact the outlook for economic activity, employment, and inflation, a monetary policy response may also be required. Federal Reserve's use of liquidity and lending programs during the early stages of the pandemic demonstrated the effectiveness of emergency lending tools as backstops to support market functioning and the flow of credit in times of stress. Lending programs are most effective as backstops when those loans are offered at a penalty rate and are of short duration. When appropriately calibrated, they can help promote market functioning and the effective transmission of monetary policy, but limit the Federal Reserve's overall footprint in financial markets in the longer term. This experience also highlights the importance of clearly distinguishing monetary policy actions from temporary central bank asset purchase programs used to promote core financial market functioning, like those that were created to support the treasury markets in early 2020. More recently, the bank failures last spring highlight that responsive, efficient, and effective bank supervision is a strong mitigant for financial system risks and vulnerabilities. The failures revealed that shortcomings in bank supervision can heighten financial stability risks. The primary focus of supervision should be to address a bank's critical shortcomings in a timely way. To effectively support financial stability, bank supervision cannot simply rely on pinpointing compliance issues, failed processes, or rule violations. It must go further to examine a bank's risk exposures, including anticipating how the evolving economic environment may influence a bank's financial condition and its assessment of risks. If the supervisory process fails to identify and escalate critical risks or to hold management accountable for known deficiencies, like excess interest risk-taking and disproportionately large levels of uninsured deposits, this raises a potential for safety and soundness concerns. Last year's bank stress also revealed that the Fed's bank liquidity and payment tools, including the Fed's discount window operations and FedWire, should be available for extended operating hours and prepared to provide support during times of stress. We should also consider what further steps may be needed to ensure that banks have access to liquidity support. In addition, we should encourage, but not mandate, the exercise of contingency funding plans and testing capabilities, requiring bank management to ensure adequate plans are in place. But in my mind, there is a very fine line between bank supervision and interfering in the decisions of bank management. Some measure of risk is inherent and necessary in the business of banking. While some changes to the regulatory framework may be appropriate to promote financial stability, we should be cautious that these changes don't impair the long-term viability of banks, especially mid-sized and smaller banks. In my view, regulatory reform can pose significant financial stability risks, particularly if those changes fail to take sufficient account of the incentive effects and potential consequences, like pushing activity into the more opaque non-bank financial sector. Poorly calibrated regulatory actions can also negatively affect economic activity and reduce the availability of credit by limiting the offering of financial products or services. These concerns are most acute when the reforms may be inefficient or poorly targeted. As an example, policymakers should carefully consider whether the significant capital increases included in the Basel III Endgame proposal meet the standard of being efficient and appropriately targeted. So I'll turn now to a topic I'm sure you all have been waiting for. What's next for the economy and for monetary policy? So looking ahead, the FOMC will continue to face a number of risks and uncertainties as it seeks to return inflation to its 2% goal. It will be important to evaluate how these uncertainties and risks affect our monetary policy decisions going forward. As this audience knows, members of the FOMC consult a range of models that consider several scenarios and their potential economic outcomes using different benchmark monetary policy rules. This type of analysis can provide very helpful input in informing my own views on the appropriate path of monetary policy. And given the importance of transparency, it's also necessary that our communications explain not only how the economic outlook affects our monetary policy decisions, often referred to as the FOMC's reaction function, but also how those risks and uncertainties surrounding the economic outlook matter for those decisions. With that in mind, I'll conclude my remarks with my own views on the near-term economic outlook, including some prominent risks and uncertainties and the implications for monetary policy. At our most recent FOMC meeting, I supported keeping the target range for the federal funds rate at its current level of 5.25% to 5.5% and continuing to reduce our securities holdings. At its current setting, our monetary policy stance is restrictive and appears to be appropriately calibrated to reduce inflationary pressures. We have seen significant progress on lowering inflation over the past year, while economic activity and the labor market have remained strong. Consumer services spending has shown continued strength through February, and payroll employment increased at an extremely strong pace today with the data we got today, but especially over the first quarter. However, most employment gains over the past year have been in part-time employment, and some of the recent job strength and job gains may reflect stronger labor supply due to increased immigration. The 12-month readings of total and core PCE inflation through February printed at 2.5% and 2.8% respectively, much lower than a year ago. However, with the annualized 3-month PCE inflation readings moving well above the 12-month measures in February, I expect further progress in bringing inflation down to 2% will be slower this year. Still, my baseline outlook continues to be that inflation will decline further with the policy rate held steady at its current level, and that the labor market will remain strong, but with labor demand and supply gradually rebalancing as the number of job openings relative to unemployed workers declines. And should the incoming data continue to indicate that inflation is moving substantially toward our 2% goal, it will eventually become appropriate to gradually lower the federal funds rate to prevent monetary policy from becoming overly restrictive. However, in my view, we are still not yet at the point where it's appropriate to lower the policy rate, and I continue to see a number of upside risks to inflation. First, much of the progress on inflation last year was due to supply-side improvements, including easing of supply chain constraints, increases in the number of available workers due in part to immigration, and lower energy prices. It's unclear whether further supply-side improvements will continue to lower inflation. For example, the rebound in labor productivity last year may have reflected an unwinding of temporary pandemic-related labor market dynamics, such as a slowing in the high level of employee turnover that was occurring during that time. Therefore, if wage gains remain elevated going forward, these effects may no longer contribute to lower price inflation in the future. Geopolitical developments could also pose upside risks to inflation, including the risks from spillovers from geopolitical conflicts and the extent to which food and energy markets and supply chains remain exposed to these influences. Another upside risk I see to inflation is from additional fiscal stimulus or a higher spend-out rate from existing and new appropriations. Although some of the recent policies may increase productive capacity in the medium term, they may add to inflationary pressures by boosting aggregate demand. I also see upside risks to housing services inflation. Given the current low inventory of available and affordable housing, the inflow of new immigrants to certain regions could result in upward pressure on rents, as additional housing supply may take time to materialize. There's also a risk that continued labor market tightness and continued strong services demand could lead to persistently higher core services inflation. Inflation readings over the past 2 months suggest progress may be uneven or slower going forward, especially for core services. And finally, there is uncertainty regarding whether the federal funds rate will need to remain at a higher level than before the pandemic in order to effectively foster low and stable inflation and support full employment. In my view, given potential structural changes in the economy, like higher investment demand relative to available savings, it's quite possible that the level of the federal funds rate consistent with low and stable inflation will be higher than it was before the pandemic. If that is the case, fewer rate cuts will eventually be appropriate to return our monetary policy stance to a neutral level. In the most recent SEP, some FOMC participants indicated that they now see fewer rate cuts over 2024 and over the next 2 years than they did in December. Some also included a higher, longer run level of the federal funds rate than in the past. And while it's not my baseline outlook, I continue to see the risk that at a future meeting, we may need to increase the policy rate further should progress on inflation stall or even reverse. So given these risks and uncertainties regarding my economic outlook, I'll continue to watch the data closely as I assess the appropriate path of monetary policy, and I will remain cautious in my approach to considering future changes in the stance of monetary policy. Reducing our policy rate too soon or too quickly could result in a rebound in inflation, requiring further policy rate increases to return inflation to 2% over the longer run. So in closing, the experience over the past 5 years highlights the enduring challenge of setting forward-looking monetary policy amid a wide and evolving range of risks and uncertainties. Taking into account this experience and the lessons I've learned over my tenure on the FOMC, an important question I will be considering is how to make monetary policy strategy and its related communications durable to a wide range of possible shocks and changes in the macroeconomy. We will continue to learn about the post-pandemic economy, and if history is any guide, new shocks and changes in the economy will eventually and inevitably occur. So while the future is full of risks and uncertainties, the FOMC's mandate of fostering price stability and maximum employment remains clear. Restoring price stability is essential for achieving maximum employment over the longer run. Thank you again, Athanasios and the Shadow Open Market Committee. I look forward to your questions.
Thank you, Governor, and again, thank you for your willingness to open this up and take some questions from us. I'm going to start with a couple of questions, and one that really some in the audience would want to hear a little bit more.
Okay.
You mentioned, of course, in your remarks the challenges with the recent inflation, but you also mentioned following the correction in policy, the inflation has been coming lower and lower and lower, but it's been a bumpy ride, and we've seen the last few readings have not been as favorable, and now we see the communication coming out of the committee, and this is what I heard you say as well, is that we need to wait for greater clarity and some resolution of uncertainties before we see some more confidence for cutting the federal funds rate. And many in the room would really be interested in knowing a little bit more your views about what are you waiting for, given that inflation has been coming down, given that, as you correctly pointed out, if you don't do anything to the Fed funds rate, with inflation coming down, policy becomes more restrictive, so some adjustment needs to be made for that. So what are you waiting for? What are the pieces of information that you would like to see before you're more comfortable in supporting the cuts that markets are waiting for?
Well, I think the important issues that I discussed in my remarks, especially the fact that we have seen a great deal of progress on inflation since we last raised the federal funds rate back in July of last year, but that progress has stalled. And it's going up and down in the most recent readings. And I think until we see a return to a downward path in a sustainable and ongoing way, I won't be comfortable changing my view at this point to seeing a cut in the near future. I think there's so many other variables and things that need to be considered as we're looking at all of the data too, and as it's being revised, is that we have a very strong labor market. We have strong GDP growth, and we have We have inflation that has remained at a very similar level and has actually stopped its downward progress. So I think all of these things come together to help me formulate my views about the future path of policy.
Okay, but you're still in the camp of expecting some Fed funds rate cuts would be appropriate, as long as the baseline scenario materializes, recognizing that in the last few months it has not been as positive as it was in earlier months, and this is where we are right now.
Well, I think there are a couple of scenarios that could happen that would change my view. If we see a deterioration in the labor market, or if we see a deterioration in GDP, all of those things factor into how you think about making decisions on monetary policy. So even if inflation doesn't start to go down, if we see a deterioration in economic conditions more broadly, that would certainly influence how I think about decision making.
Okay, this reminds me of Peter Ireland's presentation on tracking nominal GDP growth and making sure that it's stable. So I would also like to touch on one other thing. I noticed in your remark something that struck me as quite important in reference to possible structural changes in the economy and real-time data and measurement uncertainty. You know that, quote, an important question I will be thinking about going forward is how to make monetary policy decisions and communications more robust to these types of risks, end quote. And this of course, is very close to our heart, how to nudge the committee. This is one of the things we have been trying to do over the years, to be more systematic and take in a systematic fashion these risks into consideration. This also reminded me, reading transcripts from a decade ago, when the committee faced, again, the issues of how do you best communicate monetary policy, taking into account these uncertainties. In 2012, I recall going through the transcripts, Charlie Plosser, for example, I hope you're still with us online, Charlie, had pointed out that the best way for the committee to communicate its intentions for future policy would be with a policy rule, because a policy rule is systematic, it's state contingent, it can handle the alternative scenario and so forth. So with this in mind, I'd be very interested to hear your views on this. You've talked about the challenges with forward guidance and communication. What do you see as a step forward? Do you think that current practices could be improved? Do you think that adopting a benchmark rule and communicating monetary policy with a benchmark rule, along the lines of what Charlie Plosser had suggested a decade ago, would be a way to go? Is this something that the committee should consider in the upcoming discussion on revising the policy framework?
So I think at any given point in our history, and I'll point to the COVID-19 experience more specifically, and I talked extensively about the challenges that we had with the data that we were receiving and how important it was for me in particular in the role that I have with the requiring experience for community banking or state bank commission experience. I had regular and frequent communications with people who were actually experiencing the economic conditions to help me understand what the data was telling us. And so I'm not sure that, given that time period and my experience during that time, that I could look to any single policy rule that would have helped me more so than trying to get a narrative behind what the data was trying to tell us or that it was trying to indicate at the time. So I think we have to retain flexibility, given that the economy can evolve and throw curveballs at us at any given moment, and that the data that we're trying to rely on to make our monetary policy decisions can often be telling us something completely different than what's occurring in the real economy. I think, as I mentioned in my remarks too, I find value in monetary policy rules, and we have an entire section that evaluates how they would be predicting or telling us what we should be doing with the current economic conditions. And oftentimes they tell us very different things, and they rely on unobservable concepts like R-star or the unemployment rate or those kinds of things. So while I think that they're extremely helpful and beneficial to informing a more a more robust decision-making regime. I'm not sure that I could, at this point today, with the experience that I've had, point to a single rule that would be able to encompass all of those different challenges that I've had to face over the past 5 years or so, and that I expect that we will have to face in the coming years as well. But I think that they're wonderful and very helpful to think about parameters and expectations of how things should be evolving.
Well, it's a fair answer, very much in line with the historical preference of current FOMC members.
Well, remember, I'm not a PhD economist. I'm just a
to
lowly
maintain
lawyer.
a lot of discretion. No, this is the thing that I find that people inside the institution, and I recall I was doing that as well. I don't know, Andy, if you would admit to be doing that as well, Jeff. There's always this tendency to try to defend maintaining a lot of discretion and flexibility. But if one looks at the history of monetary policy, not just in the United States but also in other countries, one can identify how many mistakes can be attributed after the fact to that flexibility that looked so nice. And this is the tension that would be useful to resolve. Again, it was discussed in 2012, as we know from the transcripts. It was not resolved in a very definitive fashion. Would you be supporting that in the review of the policy framework there is additional effort to identify whether there would be benchmarks that could be useful guidance, that could offer useful guidance, or you think we've done enough work on that, so we don't even need to bother?
No, I think as we're looking at all of the different considerations and components of what that engagement will look like as we approach the time as it's appropriate to discuss that longer run statement, I think we should consider everything. But then I'm also someone who appreciates criticism, and I value criticism almost more than I value supportive comments, because I think we can always do things better. But I found your chart very compelling with the deviation between where we should have been raising interest rates and when we finally did. And it did lead to extremely steep and frequent increases in the federal funds rate that I think can create a financial instability, as I discussed too in my remarks. So I think it's important that at the very least we are consulting with those and understanding what they're telling us we should be doing and not ignoring that, but certainly thinking very deeply about the impact that it could have as we're considering that. But it's certainly, monetary policy rules should be a part of all of those conversations and discussions.
Yes, and they most definitely are. It's just the question some of us have is how closely committee members look at that particular section in the Teal book, for example, when it's there.
We do also look at that risks and uncertainties section, because we've been surprised more times than not over the last 3 to 5 years about what's actually happened and what we thought.
Before I open it up to the room, I should note that I want to give credit to the staff, and the committee, of course, has encouraged that, because indeed, looking at the evolution of the risks and uncertainty section in the toolbook, it has improved quite a bit from the old days. So I guess there is a little bit value added to the 700 plus economists that are there that we should be giving some credit for. So let's take some questions from the floor. I'm gonna start. Okay, Andy, I'm gonna start with you at the table, and then we're gonna go around.
Well, first of all, thank you again, Governor Bowman. We're really, really thrilled to have you with us today, and hopefully we'll have you back regularly over the next, we figured out 10 more years that you'll be. And by the way, I think it's great. I personally think it's great to have a diverse committee, including people with a law degree who've been a state commissioner in banking. You know, they're familiar with the challenges of community banks and smaller communities. And so I think that really strengthens the deliberative process. So 2 questions. One, Fed officials have regularly said, well, policy is restrictive, but then we keep seeing pretty strong GP growth, mostly above what we would usually consider to be the trend, and phenomenal employment growth that we're happy about. I need to look into the part-time, full-time. Thanks for flagging that. But so I kind of wonder if, in fact, maybe as we get further to ex post, that we're going to get further in the direction of saying, well, maybe policy wasn't actually all that restrictive, and that a lot of the decline in inflation was, as you said, easing of supply pressures. So I'm just curious, maybe you could share a little bit more about that. The other thing, just to follow up on Athanasios, is an alternative or even a complement to policy benchmarks is scenario analysis. And you mentioned it a couple times in your remarks and your response to Athanasios. I still puzzle, why doesn't the FOMC incorporate explicitly scenario analysis into your communications, right? It's in the staff teal book. It seems like it would be an easy way to say, as you did to some extent in your remarks, like, here's our baseline view, what we're hoping and anticipating, here's an alternative, and here's what we think we would need to do with the policy path in that. And of course, they're illustrative, because the reality is more complicated. But certainly we can imagine geopolitical events causing a downturn in the US economy in the not too distant future, and the Fed would need to respond to it. So it seems like it would be easier. Mathematical formulas are going to always be limited, where scenario analysis is really up to the committee at a given point in time to say, well, here's the risk that we can see, and here's how we think that would work out. And of course, the reality will be different in some ways, but at least to help the reaction function you were describing sort of put it into a picture. So I'm just curious again, what are your thoughts about that?
I think that's a bigger question than a non-executive member of the board. Is that how we were described earlier? I liked that. That was good. I think we do discuss those kinds of things when we have meetings with the staff as we're preparing for FOMC meetings. So it's maybe because it's not a part of our official communications, and it could be confusing. I think if we were to engage in what ifs while we're talking to the press, that generally creates a lot of distraction from, I think, what we are trying to communicate. So it is important that we're thinking about what could happen and how we might be needing to react in the future. But in my view, those might be best kept behind closed doors until such time that we might need to talk about them in public.
But this is a very good way of answering this, and I would add and hope you would agree that. But it's something that is worth considering in the strategy review. That is, it should be underway already in some fashion, or it should shortly be underway with results for next year. Yes, please. And I should be taking 2 questions at a time. So here and there.
Interested in your views on the housing market. Chair Powell's weighed in on this, said it's not part of the Fed's mission. Clearly, it is impacted by certainly the pace of increases, which has caused other dislocations, including the banking issue. But you addressed the problem of housing costs, and certainly buyers and sellers are on the sideline now, and it just sort of makes me wonder whether the idea of what Peter had proposed earlier, this idea of kind of a return to some normalcy in this environment might be sensible. And thank you as well for your service and for your comments today. Thank you.
Thank you. And the second question is Hugh. The next round.
Thanks. Thank you for your comments. The one new aspect of the financial sector since 2008 has been the payment of interest on reserves. The Fed has very generously paid interest even on excess reserves, and it didn't make much difference when rates were 0 since, but now that they're over 5%, the Fed is losing money hand over fist. The net worth is minus $100,000 last I looked, when you take into account the, quote, deferred Treasury dividends to the Treasury. But the Fed is under no obligation to pay that interest on reserves. Why doesn't it just cut the rate to 0 or reduce it substantially and cut its losses? I mean, it's in the same position as SVB, except that depositors SVB could move their deposits to another bank, but depositors in the Fed can't move their deposits to another central bank. So the Fed really is in a monopoly position. Why is it so generously paying out all this interest on reserves?
Well, both of these are excellent questions, and I'll start with the housing, the housing market. I think we obviously are not in the housing business, but we do recognize that challenges with inventory and available interest rates for mortgages and things like that really impact the number of homes that are sold or the availability of housing more broadly across the economy. These are all important constraints and challenges that I think affect other parts of the economy as well. So as I mentioned in my remarks, I think we already know that there's a housing shortage across the country, but we know that there are also a number of projects that have been embarked upon over the past few years for construction activities. So hopefully at some point there will be a little bit of easing as maybe mortgage rates decline and more housing becomes available. But probably didn't answer your question very well, but that's okay. And I think your question raises a lot of very important issues, and I don't have an answer for you, but I appreciate the fact that you raised the question.
And I think we have time for maybe 2 or maybe 4 questions. We'll see the time. So first there, then no, it was yep. Okay.
Thank you so much for the wonderful talk. So my question pertains to whether reductions in the balance sheet are monetary policy in the same way that increases in the balance sheet are monetary policy, but sometimes members of the FOMC express views that reductions in the balance sheet are not monetary policy. And it matters to me, I think, because, well, for a lot of reasons, but in particular because changes in so large-scale asset purchases, as you know, work through several channels, one of which is reductions in the overall amount of interest rate risk in the market, right? Portfolio balance channels, the overall supply of duration to the market, right? That's sort of a quasi-fiscal operation because the amount of duration into the market pertains to the maturity profile of Treasury issuance, which is a decision made by the Treasury Department, right? So the issue that becomes relevant when allowing the balance sheet to reduce in size is that the Treasury can effectively offset the increases in duration injected into the market by the reduction in the balance sheet by changing its issuance profile, right? So what Treasury has done in the last year or so has been to dramatically shorten the issuance profile of its debt issuance, right? Now, that's had the effect of offsetting the duration injection provided by the Fed's reduction in its balance sheet, effectively loosening financial conditions just as the Fed was trying to tighten them by reducing its balance sheet. So my question is, what evidence do you think it will take for the FOMC, for members of the FOMC to change their views about whether reductions in the balance sheet are monetary policy in the same way that increases are? Because by sort of eroding the barrier between fiscal policy and monetary policy, the Fed has allowed some of its independence to be impinged on by actions by the fiscal authority, by the Treasury, insofar as reductions in duration supply have been offset, reductions in increases in duration added by the Fed's balance sheet roll down have been offset by reductions in supply by changes in the Fed's maturity profile. Thank you.
Thank you. Could you pass the mic 2 rows in the front? Thank you.
This will be your balance sheet round, because I have a question also. On the surface, you look pretty tight, right? You got a relatively high real Fed funds rate, and you've taken $1 trillion of liquidity out of the markets with QT. I think that's approximately correct. However, under the surface, or your backdoor, as I like to think of it, you've got reverse repos winding down to the tune of $2 trillion. So while you've taken $1 trillion of liquidity out of the markets with QT, $2 trillion has flowed in from reverse repos. The track of reverse repos coincides with the stock market boom that's happened in the last few months and with the easing of conditions. So do you think, broad picture, do you think that the way you have your policy and balance sheet structured, where you're subject to these really uncontrollable reverse repo, or maybe they are controllable if you change rates, but that they're offsetting what you're trying to do with tightening policy?
think these are all very complicated questions, and they're very important for us to think about as we're embarking on quantitative tightening or reducing our balance sheet. I think it is an important part of the decision making that we engage in at the end of sort of a quantitative easing cycle and understanding what the appropriate level of our balance sheet should be. We don't control the issuance that Treasury makes, and we recognize that their role is to support fiscal spending. So while it is related, it's not our responsibility to oversee or control that. It is critical in my mind that we're continuing to reduce the level of the balance sheet. At $8.5 trillion, as I mentioned in my remarks, from $8.5 trillion to where we are now, which is just about $1.4 trillion lower than we were then. I think there's still some ways for us to go before we're at any point where we might define that as ample reserves. So I think we do need to continue doing that. I'm not sure that I think that it is a monetary policy action to engage in allowing for the securities to roll off our balance sheet. And I think as we see financial conditions potentially being impacted by that, then we understand where the right level is for us to stop doing that or to ease up on the pace of balance sheet reduction. And again, you raised important points on the reverse repo issues and things that we're thinking about and talking about now. So I appreciate the raising the issue.
And we're just about running out of time. I wonder if we should take one or two more questions. Let's do two more questions. Yes.
Okay, something maybe a little simpler than reverse repos and all the rest of it. There's a camp out there that says, hey, what's wrong with 3% inflation? Just relax. Policy is restrictive, cut rates. And I think the other side of that would be, what if inflation stalls out around 3%? That's roughly where it is now, depending on which measure you're looking at. What do? Do you say, okay, fine, we'll just wait and see what happens? Would you think of raising rates, or would it be a case where if it stalls at 3%, that's okay, unless the labor market gets even tighter and hotter? How does that look to you? I know you're not there yet. You did say it wasn't your baseline, but you thought there could be a chance that you would actually have to hike rates in the future.
Okay, and one more question. At the very back, there was a request earlier. That's going to be the last question.
Hi. Just in terms of its sort of historic role and connection to money, is the Fed tracking the price of gold and the fact that it's at a high, which in effect means the dollar's at a low in relation to it? Just curious.
One more, or is that it? Okay, so I'll first talk about commodities and gold. And of course, we look at a number of different measures to help us understand price pressures and influences of very influential conditions that we should be thinking about, especially in the role of the dollar internationally. So yes, we are thinking about it. I don't know that we're thinking about it more strongly than any other indicator at this point, so broadly looking at financial measures. Your question about 3% inflation, of course, is one that has been asked a number of times, I think, over recent history, given where we are with the level of inflation. And it's an important thing to think about. We do have a goal of 2% inflation. So in my mind, as I'm thinking about it, and as I said in my remarks, if we find ourselves at a point where inflation has stopped, we've stopped making progress on lowering inflation, or if we're seeing other indicators of that would tell us that the policy rate is not restrictive enough to make more progress, then we certainly should be. It's not my baseline outlook. It is not in my SEP. I don't have any increases. I took those out in December of last year. But I do see that that there's a likelihood that things could evolve in a way that might require us to affect the policy rate again in an upward way.
So thank you, and thank you for providing this And I'll close by suggesting that one concern, because it had been suggested by others, is that the Fed could go back and start reacting opportunistically, as it had done at some point in the past. And especially in the environment where there is a difficulty in adopting a very explicit policy rule to describe monetary policy. Policy that is focused on returning to a 2% target is one of the important elements that we have of systematic monetary policy. So I really appreciate that you stress this and very much appreciate your remarks. So thank you. So thank you again. The meeting as well. So this is the end of our meeting. Want to thank our hosts here for hosting the meeting, and thank everybody for